Thank you. Mayor CRANLEY, I know it's tough to get connected sometimes. So good morning, everyone. My name is John Rickert, and I'm the owner and executive managing director of Lee & Associates and General Contracting Partners. For the last 5 years, we've partnered with RE Journals to provide the highest quality speakers and commercial real estate topics for the Cincinnati Real Estate Summit. Our focus continues to be professionalism, market knowledge, and inclusion. Lee & Associates believes that the best possible live, work, and play environments are achieved by integrating local government, community leadership, public and private financing, construction, and ongoing real estate management. At 11 a.m., we will provide insight into 3 Cincinnati developments that meet this criteria. Please note the emphasis each developer places on the integration of stakeholders and partners to create transformational impact that allows all interests to benefit. Now, it's my pleasure to introduce our keynote speaker, Cincinnati Mayor John CRANLEY, a nascent Ohio gubernatorial candidate. I've known Mayor CRANLEY for many years and admire his work ethic and his integrity. During his term as mayor, John CRANLEY has led a renaissance in our community using his influence to facilitate the intersection of real estate development, businesses, education, and healthcare institutions, and entertainment spaces. John is a true champion of economic growth, inclusiveness, and community vitality. Please join me in virtually welcoming Cincinnati Mayor John CRANLEY.
Thank you. It's great to be back with you, John, and this great group of real estate leaders. In what has to be for all of us, very uncertain times, very interesting times. And for those of us who have been touched by the tragedy of the pandemic and loss of loved ones, a difficult time and sad time. And I don't want to neglect to acknowledge that all of us in some way have been affected by people who have died from COVID, including some of my best friends' parents and others. But I do want to bring good news. And I also want to leave lots of time for questions. I believe that there is lots of reason for hope and excitement for this summer. In fact, I think this summer could be one of the great summers of good feelings in the history of Cincinnati. We are right now literally digging up the ground all the way from the banks through Findlay Market. And what we're building as we speak is the largest expansion of pedestrian-friendly street closures, lane closures in the history of the city to really build out an incredible outdoor dining quality of life experience. We already have the best riverfront park in the country, and we have an incredible vibrancy around Washington Park. And we have, with the help of Fifth Third, a new stage at Fountain Square that will be in its full bloom once people feel safe coming back down this summer. But on top of all that, finally, the banks, group restaurants, and bars in front of the Red Stadium between Main and Walnut have figured out how to literally tax themselves to add entertainment throughout the year. And so by April, we will have a permanent outdoor entertainment district where you can drink a beer and walk around the district, not just for special events once a year, but on a nightly basis. And we're putting significant money in to make the transformation of that street be closed permanently to make it look really beautiful. Heading north, we're going to have incredible pedestrian expansion around the old Macy's at Fountain Square, as 3CDC is reconstructing that and is going to be adding in a whole lane of sidewalk. Then as you head north from there, Jeff Ruby's is going to take an entire lane on 7th Street and expand permanent outdoor dining, including, I believe, they're going to build a chandelier that will be outside and will be very high class, as everything we've come to expect from them. Then As you may know, Court Street is under construction right now, which is a dramatic pedestrian expansion, pedestrian plaza expansion. And 3CDC is repopulating that street between the Kroger headquarters and the Kroger building, the new Kroger grocery store with condos and retail. And then, of course, everything in Over the Rhine that was temporary orange barreled street lane closures last summer is going to be permanent, either parklet or sidewalk expansion. And then streets like 15th and 14th in certain areas, like outside of Pep and Dolores or outside of Salazar and Zula, will be permanently closed, and it will feel like a European city. Similar expansions of the street at Liberty, which are under construction now, and Finley Market. We all know that in normal times, that amount of construction would drive people, crazy in terms of being able to commute. But we all know that at this time, for understandable reasons, downtown is effectively a ghost town. But people are going to come back, and they're going to come back this summer, and there's going to be lots of reasons to come back. One, it'll be safe. Two, the Reds, who went to the playoffs last year, are going to be playing games with people. FCC, brand new stadium with a new season, and one of the largest acquisitions with Brenner in the history of Major League Soccer. So, people ask me all the time, after having won the championship in the minor leagues, would FCC have what it takes to win at the majors? And obviously the first two seasons have been tough as a brand new expansion team. But the acquisition they made, $13 million, is historic. It tells me that the owners are going to do whatever it takes to make FCC competitive. And that's going to be a lot of fun. And we're going to be adding incredible excitement to those Central Parkway in front of the stadium. And then on top of everything else, hopefully theater will be back, Music Hall, the Aronoff, et cetera. And so I believe that by the 4th of July, people will desperately want to enjoy time together and re-establish the cultural amenities that our city has to offer. But at the same time, when they come back down, they will not recognize what they have rediscovered, because we will have used this time not to twiddle our thumbs and wait for people to come back, but to build Cincinnati. And it's very exciting. And that's just, of course, discussion of downtown to Over the Rhine. There is incredible transformation of neighborhoods that is ongoing, whether it's the Incline District in Price Hill, whether it's the Westwood Town Square development, which is just, every time I go there, it's just better than it was the time before. Ivory House just opened recently, and Nation Kitchen on top of the brewery, and Muse. College Hill Business District, the Japanese restaurant, is amazing, that is opened. And on and on and on. Walnut Hills, People's Corner, a place that many people would have been scared of 5 years ago, is now vibrant, both on the west and the east sides of Gilbert and McMillan. It's an exciting time of rebirth. Madisonville, Evanston, all have seen tremendous rebounds. So I'm very proud of where we are. I think it's certainly the case that last year was by far the most difficult year for probably all of us, but certainly me professionally, helping to lead a city through COVID and a George Floyd summer. But we're going to come through with a better city and a more just city. Separate from real estate, we became the first city in America to make meaningful reform to police discipline in the aftermath of George Floyd. I'm very proud of that change, which will make us easier to hold the occasional bad officer, Apple, accountable. But also, we are working to build and expand the Black middle class in this city in a way that no other city in America is. And I think that will be some big news coming out throughout 2021. So those are just a few highlights of some things that I'm working on and have worked on, and as we're heading into this spring, and would love to open it up to any and all questions for you guys.
Yes, if you have questions, pop them in the chat room there. John Rickert, you got any questions?
So I have an observation. I mean, I think it's interesting that you've been able to leverage COVID or the COVID environment to facilitate construction and improvements and make them less onerous on the downtown population. But I guess what I'd like you to address, if you would please, is we've talked a lot about entertainment and sort of recasting the city. What about industries and jobs? I know you're out there plugging all the time to bring businesses into the region. You want to speak to that for a few minutes?
Yeah, I mean, look, I think we've had tremendous job growth over the last 7 years. We provide an incredible quality of life and access to great cultural amenities in normal, non-pandemic times. There's been an incredible rediscovery of Over the Rhine and interest to live there as well as work, live downtown. The population of downtown Over the Rhine has more than doubled in the last 10 years, and I think it'll double again in the next 10 years. And so I think we're going to continue to be an attractive place for job growth. I mean, Kroger and most industries I know of in downtown Cincinnati are adding office jobs, or had been prior to COVID. Obviously, we're all nervous as to what's going to happen post-pandemic in terms of work, remote work, et cetera. And my guess is there'll be some permanent change, but I also think the change may be exaggerated. We'll find out. I think that no matter what it is, Cincinnati is going to be positioned to attract talent and bring more people and more jobs to the city.
Very good. Would you like to speak to your aspirations to be the next governor of Ohio?
Well, I haven't made a final decision on that race, but at a very big picture level, you know, the things I'm thinking about are that Ohio has for decades now been in a decline and loss of its middle class. So, and I mean that literally 30 years ago, 50 years ago, we had the biggest middle class in the country, or at least one of them. And the income for the average Ohioan was above the US median income. Now the average or the median for Ohio is 89%. That is a devastating loss over several decades. And there's really just two exceptions to that decline in the state of Ohio. It's the greater Columbus area and the greater Cincinnati area, both of whom have incomes above the US average. And so, or median, I should say, is a proper term. But, you know, why is that? And I think it's clear that we've had one party run the state for 30 years. And their policies have been a dramatic failure. Conversely, Columbus's politics and policies have succeeded, although theirs was different in that they had the capital and they were never declining. But Cincinnati was like the rest of the state. It was declining in population, suburbanization, and brain drain. But now it's rising again. For the first time in 70 years in this census, we will have a significant increase in population in the city proper. And the region is one of the fastest growing economic regions in the Midwest 3 out of the last 5 years. So we are a comeback story. And Ohio needs a comeback and therefore deserves a governor who has led a comeback. And I'm proud that with the help of many other people that we've been able to orchestrate a comeback. And those are the kinds of policies and success that all people of Ohio deserve.
Certainly well said. Todd, I think we're at our time. Would you like to take it back and transition to the next panel? Mayor CRANLEY, thank you so much
for
for joining us.
Thanks, John. That's fantastic. Let me change the view back here to gallery view. Hey, I love the leadership, man. Let's usher in a new era. I think we're headed into the most entrepreneurial decade in our lifetimes because of all the businesses that people have gone out of business. They're creative people and people with wonderful new ideas. I'm looking forward to seeing this explosion of, the roaring 20s again or something to come out of this next decade. So you be governor and we'll go get them, right? Make it all happen.
That's great.
All right. Okay. Everybody that's on the second panel, Jessica here is our moderator. Thank you for activating your camera. I might have turned your camera off if you were kind of flashing in and out or had something weird going on. It's good practice to turn your mic off when you're not talking. So don't forget to keep that off and on. If I have to turn it off, I can't really necessarily turn it back on again. So if I hear background noise, sometimes I'll just click the off button and I'll turn you off. Don't panic. You can push your button and turn it back on again. Those are at the bottom of your screen. I just want to do one thing real quick, and that is get back to our lobby. Just again, to show you all, this is where you're going to be able to find information on this panel. And don't forget about these LinkedIn buttons. I just connected with all 6 of these people. Hopefully they accept my friend request. But this is where you can also see their agenda, and I will flash their photos and stuff up as they're being introduced. Okay, Jessica, if you're ready to go, I'll be here in the background listening, but you won't see me or hear me unless you need something.
Great, sounds good.
Can you hear me? This is Tracy. This is Tracy. Can you hear me?
Yes, we can hear you.
Because I can't get my video. Okay, because my video, I have a slash through it, but it's not allowing me to click it to turn it on.
Hold on. Tracy, try it now.
Okay. It asked me to start video. I click start, but it's not doing anything.
Well, you can log out and try to log back in again. That sometimes fixes things, or we can just listen to you and I'll put your picture up on the screen when you're talking.
Purposely just took a shower this morning for all this. Yeah, I don't.
We'll let you monkey around with it for a minute. Jessica, take us away, and Tracy, if you're having trouble too, feel free to text Alyssa, one of our staff people. She can help you.
Great. Well, I think I saw all of our panelists on with us this morning, so I think we're good to go there. But if anybody else has any technical issues, please let Todd know. So good morning, everyone. Thank you for joining and welcome. I am Jessica Odenweller with Equity, and will be the moderator for this wonderful group of panelists to discuss the multifamily sector. We have prepared a list of questions to discuss, and I believe it's going to be a lively conversation. However, we do welcome questions from the audience throughout this segment of the event. Please, I welcome and I challenge the audience to maybe give a little bit of challenging questions to our panelists, as they are extremely smart and intelligent in this sector. So let's get things started. And how about Nathan? Do you mind starting and introducing yourself for today?
Yeah, absolutely. Nathan Murphy with Capstone Apartment Partners, based here in Cincinnati. My team focuses on Ohio, Indiana, Kentucky, but with a strong focus in Cincinnati, where we're based. As a firm, we specialize in the brokerage of multifamily assets, and we've grown to become the #1 private multifamily firm nationwide in brokerage. So that's been an exciting jump in growth for our firm. We did about $1.8 billion in transactions last year as a firm, with a good portion of that coming here out of the Cincinnati office. It's led to a strong 2020, and we're really seeing a strong 2021 coming forward, which I'm sure we're going to get into in detail, but just as a brief introduction, and excited to be on the panel.
Great, thank you, Nathan. How about Noah?
Thanks, Jessica. Noah Juran here with NorthMarq. NorthMarq is a privately held mortgage banking company. So we source debt and equity for our clients for all different property types. We specialize in multifamily in Cincinnati and also throughout the country. Last year was a very strong year for our office. We did end up hitting our goal, which back in March, April, I don't think anybody would have thought that was possible. So we were really pleased with how the year ended up. Interest rates remained low. Our clients were active and really taking advantage of the drop in rates. As a company, we are the largest privately held mortgage banking firm in the country. We've got 38 offices around the country. And last year we did $13.7 billion in total originations, which was up about 11% year over year. So it was a great year for the company and a record year as well.
That's fantastic. I can't wait to hear a little bit more about that one, Noah. How about Kurt? Mind introducing yourself?
Sure. Thanks, Jessica. My name is Kurt Shoemaker. I work with CBRE, focused on investment sales and multifamily. I've been in the business for about 12 years now. I'm on a 3 or 4 person team. It's myself, Marianne Taylor, and Dave Lockard. We focus exclusively on multifamily in Ohio and Kentucky. Last year was a little slower year with COVID, but things have really started to pick up now. Our firm, CBRE, is the largest commercial real estate company in the world. Last year, we, as a firm, did, I think, close to 30 billion in sales. I think our team did about half of that, but no, just kidding. But no, happy to be on the panel and look forward to discussing the market more.
All right, Traci, although we can't see you, how about you introduce yourself? Can we hear you now? Can't hear you anymore?
I asked her to pop out and try to log back in.
Oh,
again.
okay.
Maybe we'll skip her and see if she comes back in.
Yeah, let's go to John. How about John?
Sure. John Sullivan with Tbg Development. We are a multifamily developer based out of Indianapolis. We operate both heavily in the Midwest, but are now nationwide as well. In Cincinnati, we have several properties. We've redeveloped the Sand School in the West End, with which some of you may be familiar with. Also have a couple other affordable properties in the city. We also focus on market rate as well, but the big project that we're undertaking right now in the Cincinnati area that some of you may be aware of is the Crosley Building right off of I-75. Right now it's a big vacant building with very cool history to it. It was the former home of the Crosley radio company, and we are underway in the redevelopment efforts of that one. Probably won't be able to start construction on that for a little while, but there have definitely been some favorable economic conditions and also, I guess, legislative conditions that have led to properties like that being better positioned for redevelopment. So excited to get that one going and excited to talk here on the panel today.
Great. All right, do we have Traci with us, Todd?
We have audio.
You have my
not
voice,
video.
but you don't. Sorry, guys. Well, I'm here. It's Traci Boeing with WesBanco Bank here in Cincinnati. We are based out of Wheeling, West Virginia, and we are doing a lot of commercial real estate deals for our clients and for projects that are located as far as in our footprint. So our footprint encompasses Ohio, Kentucky, Indiana, West Virginia, Pennsylvania, and then also a couple years ago we just purchased a bank that got us into the Washington, D.C. and Baltimore area. So as long as our customer and the property are in those geographic locations, it doesn't matter any product type as far as for commercial real estate, we'd like to take a look at it.
Great. All right. Well, thank you guys for introducing yourself. And I know a couple of you already answered this question, but I think a few of you can still address this one. I am just curious on how your 2020 actually ended up, and looking into 2021, what are you guys seeing and projecting out for this year, just in general for you and your team? Traci, why don't we start with you? I know that a couple of you guys, again, answered the question already, but maybe there's a few more details behind the scenes that you guys can share with us. But Traci, let's start with you.
Sure. We had a great 2020. I don't think that that's what everybody had expected as far as going into the year, but we had a phenomenal 2020. And really, if you look at the pipeline going into this year, we're expecting another great year as far as for this year. There's several projects we're working on right now, and then other projects that we're very much aware of that are coming as far as throughout, second, third, and fourth quarter. But right now, everything looks very positive. Things are a little bit more conservatively underwritten, but in terms of the pipeline, everything is full steam ahead.
Great. Okay. And I'll open that up to the panel if they want to, if anybody else wants to give any further detail from their previous answer.
Yeah, I'll add to that. I mean, 2020 was maybe March, April, maybe May as well. There's some uncertainty on what was going on, and things were paused for a while. Like the lending, essentially stopped for a few weeks there as everybody was figuring things out. But overall, looking back at the end of the year, it was another great year for multifamily. I think that just speaks to the multifamily space. And I think it's just really solidified multifamily, honestly, as we continue pumping money into the economy. When's inflation going to kick in? People are going more towards these real assets and multifamily. So that's just continued growth. I mean, as a firm, we've seen it as an opportunity to grow. We've added, last year, we added an Atlanta office, we added an Oklahoma City office, we launched an equity platform, and then just about a couple weeks ago, we added a Denver office. So with a lot of those offices being really at the end of the year, our firm still saw over 100% growth from 2019, which was further growth from 18. So we've seen quite a bit, and I really expect that growth to occur again here in 2021.
Yeah, just to add, 2020 was a slower year investment sale wise. I think nationally is down about 30%. From 2019, but as Nathan mentioned, the long-term fundamentals in multifamily have become even more attractive coming out of COVID. So we anticipate this year being incredibly active with a lot of pent-up demand on the sales side, and more and more capital coming into the space as well.
Yeah, and I can touch on the development side. It definitely has been a unique year, but development's typically something like a 4 to 5 year life cycle from finding projects, working through the entitlements, all of that, getting financing lined up, and the construction and the stabilization. So certainly it's been its challenges. Lease up was certainly tricky this year on properties that did get complete. We definitely had less traffic at our properties, at least to start off with. But I think, as everybody's touched on, multifamily still has some very strong fundamentals. And so we're certainly bullish on multifamily. It has allowed us to kind of reposition ourselves, get into some new markets, as well as kind of open up new opportunities. It's one of the things on the development side. We are constantly pivoting. So we've actually had a couple of properties on the multifamily side, which we've actually pivoted from targeting as market rate properties, that we've switched over to the affordable properties, just because there was some little bit, better incentives or economics in order to get that done. So it's been an interesting year, but one that we're excited moving forward, and certainly don't think the conditions are going to last in the market like they are right now.
Thanks, guys. Yeah, as I mentioned earlier, we exceeded our office goals, exceeded our goals as a company. Again, a lot of that had to do with interest rates coming down. The 10-year dropped to, I think, 52 basis points in the summer, and our clients took advantage of that through Fannie and Freddie refinances. We still did a lot of acquisitions. Life companies, which is the backbone of our company, continued to lend through the COVID pandemic and continue to lend today. Our pipeline for this year is very strong. A lot of that, again, has to do with rates remaining low. We're seeing spreads right now as low as 125, 130 over the 10-year for low leverage apartment deals. And, if you're an apartment owner, you'd be crazy not to take advantage of that right now.
So in that vein, Noah, and whomever on the panelists would like to join, maybe Kurt and Nathan, you guys can join in on some of the creative things with all the deals you guys were doing last year and into this year. What are the creative things that were done to get some of these deals done? I mean, it sounds like everybody was taking advantage of the interest rates, as you were saying, Noah, but are there some other creative things that people were doing, buyer and seller and brokers, lenders, that they were doing to get deals done last year?
For us, not really. It was, I would say the underwriting was more heavily scrutinized. So we had to work with our clients to, ensure a great execution. But, we still closed over 40 deals, and I think a couple of them maybe had some more hiccups along the way than normal. I mean, every deal is tough to get closed, but at the end of the day, it was about understanding collections, understanding delinquency, understanding, any forgiveness at our property or across our client's portfolio. So again, just more scrutiny, more questions. Process took a little bit longer, but overall it was business as usual, just in a different environment. Right.
When COVID started, I I think we all took a pause and didn't really know what to expect. And, March through, call it August, in the multifamily space, no one was doing much except focusing on collections and, keeping their staff safe outside of refinancing. People were taking advantage of rates, but at the same time, there was a lot of unknown and question marks with some of the holdbacks that the agency lenders were requiring with, principal and interest payments for a year and different things. So it took a while to get people to wrap their arms around some of the changes and new world that we were in. But like we spoke about, once they took a step back and realized that the fundamentals and operationally properties were still doing very well, people started to get back into the sales side of things. But I guess to really answer your question, Jessica, the creative side, I don't know if there's really anything that you could say except, and I actually talked about this last year, but the amount of people that are trying to invest and investors that are out there trying to get into the multifamily space, it's become even more competitive recently because I know we're at some other panels today, but retail, office have changed a lot, and the appetite to invest there has along with it. So we've seen a lot of new capital into the space. So if you want to be in the space, I guess you got to be ready to compete and have very aggressive terms. Where 10 years ago, no one talked about hard money day one in our market, and now it's common. So I would say that's the biggest, I guess, if you want to call it creative, but the ability to get aggressive, I guess.
Pony up more money in a shorter time frame and due diligence. Absolutely, yeah. I could see money talking. That always is, right?
Yeah, exactly.
It's all together.
Wow.
Yeah, so like for creative ways, I mean, it really is kind of the other way of how it would apply, being more aggressive. Like Kurt mentioned the reserves, particularly with Fannie Freddie early in the year. I think we, at least from my perspective, was a little nervous about that it was going to cause change in pricing and interest. But once we actually understood it made make adjustments to underwriting just to adjust to the market. It really didn't have that big of an effect as I expected or feared. But like early on in the COVID stages, creativity in terms of maybe extensions accommodate DD, travel restriction, third parties taking longer, just kind of buyer seller working together. But that's really like the extent of the creativity we saw. There's still a lot getting done. I mean, from a brokerage side, I guess you have to go more virtual, more videos and kind of interviews with staff to kind of bring the tours to people's computers when they're visiting properties. But I would say that was probably the most creative thing that needed to be done, and an investment that needed to be made on behalf of buyers.
Would you guys say, because in my world there was some acquisitions that were going on pre-COVID, and then turned around after COVID, well actually during COVID, deals fell through because there was a lot of fear in the market and not knowing what was going on with the economy and just overall what was happening, let alone in the next 6 months, but almost in the next 30 days. So did you guys see that deals dropped off, obviously, and then a lot of those deals came back in, the 3-6 month period after, particularly Cincinnati or Ohio shut down in March of last year? Did you guys actually revive a lot of those deals, or was it more so drumming up new business?
Yeah, it was a little bit of both. I mean, in the first quarter, second quarter, as a team, one of our goals was just keep every deal alive. When we're all scrambling to figure out what's going on, and if it's the extensions or whatever it is. I think we had one that ended up, falling through because of really unemployment concerns. What was going to happen is obviously we're losing a lot of jobs as restaurants and things like that are closing down, but are those coming back? And which we're kind of seeing. But yeah, I mean, it was really, keep them alive, push them. If it was supposed to close in April, maybe it closed in June or July. And then once everything became more clear, the activity was there. A lot of closings in the third and fourth quarter and spilling into 2021 as well. I imagine, Kurt, you'd probably see the same thing.
Yeah.
Sorry, go ahead, Kurt.
No, it's a lot of this ditto, I guess, to what Nathan said. I mean, a lot of deals that we had in progress. I think we did have one that fell out, but then has now resurrected. So The large majority, though, continued on as planned, and were able to get closed. And yeah, so.
Did you guys see a lot of retrading at all?
We did not.
No?
Part of that too, honestly, was just the stage of the deal that with non-refundable money and things of that sort, which made it much harder for the buyer to go back and ask for an adjustment. But we really did not. I think, just touching on that further, I think, when COVID started, everyone was talking about the COVID discount and expected cap rates. Our team put together a survey with, I think it was close to 50,000 units total that were, responded from ownership groups. And when we first put it out at the beginning of COVID, I think it was 7,500 basis point, upswing that people expected come fall of 2020. Whereas, fast forward, if anything, it's a COVID premium in the market that we're in, and instead of the discount. So part of that's interest rates, part of that's the demand and capital, like we talked about. But just kind of interesting where you would have expected at the beginning for retrades and a discount, but it never really materialized.
Yeah, I agree with Kurt and Nathan. We saw some deals that were under contract that took a little bit longer to close. Part of it has to do with lender underwriting criteria and expectations and tracking collections, really up until the day of closing. And we're still seeing that as well. But what was really interesting, and I'm sure everyone else here can attest, is that most of our clients and even the acquisitions that we're working on, we saw that net operating income was up. Everybody was up, certainly in the first 6-8 months. Because turnover was down, repairs and maintenance were down, expenses were really down, and collections were still very solid. I think if you look at some of the maybe a C class or low class property, you might have some collections issues there, but overall we saw that NOIs were up, and that helped those the acquisitions get to the finish line.
Yeah, exactly.
Jessica, it's Tracy. I'll add too, in terms of the fact, as far as what Noah was saying, I think the banks took a little bit more conservative approach, and hence the reason why some of the loan to values and loan to costs shifted as far as to the more conservative side, was because of the fact nobody really knew as far as to were renters gonna try to go with the eviction process, and you can't evict them, so they're just gonna sit there and they're not gonna pay rent. So nobody really knew if that was going to take effect or not. So I think that's one of the reasons really why you saw become a little bit more conservative underwriting.
Yeah, that kind of goes into the creative question before. I mean, from the ownership and management side, I mean, getting creative with collections and being a little more lenient, working with people, maybe 2 payments or working with different organizations. So that happened. But yeah, I mean, in March, April, May, every conversation I had was, well, April collections are going to be terrible. So it's like less likely to see. Well, they weren't. May collections are going to be terrible. June and July. So everybody was out there looking for this COVID discount, and it just didn't happen. I mean, Kurt, everybody tries for a retrade. It just never happened. And really prices went up, rent went up, and it just created more demand in multifamily. Like if your collections are down 1-2% in those last year, any given month, like name another business that happened to. I mean, that's a great position to be in. And so that was really the argument. And so any discount that was asked for just didn't happen.
As far as underwriting, Noah, Tracy, you guys kind of alluded to this earlier. What kind of LTVs did you guys see it drop down to for underwriting new deals, refinancing, even development deals? What were you guys seeing out in the market?
We're seeing right now in terms of, for most part, a lot of the banks are being more conservative, that you're 65 to 70% loan to value and maybe 75% loan to cost. We're a little bit more aggressive as far as than that, but that's what some of the bigger banks are doing. Underwriting maybe to like a 120 on a 5.5, 30 type basis. And if you're an out of market deal, then obviously those numbers get more conservative yet.
Yeah, I'll definitely echo that from the.
Go ahead, John.
Yeah, and I was going to say from the development side, if we're looking at new deals, it's definitely been trickier on the underwriting. We're definitely getting a lot more scrutiny. I think part of it goes to, kind of what you alluded to as far as people are staying in the properties. They're not necessarily moving. So I think operations are great on properties that are full and stabilized and, tenants, there's not a lot of turnover. But when you've got the new properties that are leasing up, it's definitely been a lot trickier just because people generally aren't moving as much. They're not getting out and about. They're not driving by properties and saying, oh, that looks nice. Maybe I'll check that one out. So it's definitely been a little bit harder getting folks comfortable with maybe some new properties, whereas I think existing properties certainly have been easier as far as showing the financial stability of them.
We've seen commercial banks, and Traci just touched on this as well, get more conservative. They're looking to preserve capital and put it out to repeat borrowers, people they know and they trust in market, being more selective on new projects and new deals. There's another round of PPP loans that just came through. So we're seeing banks get tied up with that. And frankly, they're not focusing that much on new business development, which, for us is both good and bad. We work with a lot of life insurance companies as well, and Fannie and Freddie, as well as alternative lenders. What we've started to see on the construction side is a pickup from life companies for construction perm requests. And also, like I said, some alternative type lenders, non-bank lenders who can do higher leverage construction loans. They can do non-recourse construction loans. And we've seen institutional equity come in to fill the gap if it's a lower loan to cost bank deal, say 50 to 60% loan to cost on the first mortgage, and then maybe a mezzanine or a preferred equity piece behind that going up to 75 or 80%. Some cases, we can do participating mortgages up to 90%. So we've seen alternative lenders come through and really fill that void. It's a little bit higher cost of capital, but it's also a good alternative and certainty of execution. For Fannie and Freddie, they're still able to get up to 80%. And I think that's really unique in the marketplace right now. As Nathan and Kurt mentioned before, they do require a 12-month, typically a 12-month principal and interest debt service reserve, which you can get back within 12 months if your performance maintains. So they're still at 80%, 120, 125 debt service coverage. Again, more scrutiny on collections as we inch closer to closing. And the life companies, they're slow and steady. We're, again, seeing rates extremely low from them. What's great is that they're all competing for the same business. They all want industrial and they all want multifamily. Those are the two favorite product types right now. So it's really a race to the bottom on the interest rates for a good quality product. Their leverage points have always been 65 to 70%. Occasionally they'll go above that, but they haven't strayed from that. Their portfolios are very solid with minimal issues, very little givebacks. And again, they're pricing aggressively to win business.
Kind of picking up off what Noah said too, in terms of one of the things that happened to the banks last year and into this year is every financial institution has a bucket as far as a comfortable level of how much they want to hold for any one product type. And typically each year, you have a good amount of payoffs that are coming. But because of last year with COVID, everybody sat on the bank's balance sheet and nobody was doing any payoffs. So that multifamily bucket just continued to grow and grow and grow. And so it's one of those things where now the banks are kind of waiting for some payoffs to happen so that they can put the new stuff on. Hence, like what Noah was saying, a lot of the banks are here like, hey, I'll take care of my existing customers and stuff, and we'll keep going. But in terms of we need some of these payoffs to occur to open up that volume a little bit more. But I think we're starting to see the payoffs starting to come in. We know of payoffs that are starting to happen that'll happen throughout the rest of the year. So I think you'll see that loosen up as we go throughout the year.
So in speaking of, LTVs, LTCs and all that, I want to kind of jump into the conversation of appraisals and valuation. So, and directly with that is talking about the NOIs of these properties. And this is open to anyone to start the discussion, but how have cap rates, particularly my question is, how have cap rates fluctuated over the last 12 months? And I know, just to kind of quote what John, Rickert, and Todd were talking about earlier, I know someone had mentioned that The cap rates are obviously higher here than it is on the West Coast or East Coast and all of that. So how have you seen it fluctuate over the last 12 years compared to other markets and the advantage of being in this Midwest Cincinnati market?
I think I'll start. When COVID started, like I mentioned earlier, they're in the marketplace thought that there would be a COVID discount and cap rates would go up, but the opposite has happened, and cap rates have gotten compressed even further than I think anyone could have imagined. You combine the fundamentals with interest rates and with the competition, it's really what's driving it. So, it's interesting. You look at some of the West Coast markets or Denver and some of those bigger core markets, and the cap rates that are trading there, sub 4%, where, today in Cincinnati, where, people in the fives is kind of commonplace, depending on the asset class and deal story. And when you get into the whole tax discussion on where those are underwritten, it can really swing things as well. So, cap rates overall have continued to compress, and I think that's going to continue this year and get even lower, and to levels that no one would have thought, probably 12 months ago, and for sure, back further than that.
Yeah, I agree. Like Kurt said, I mean, it's fives, low fives oftentimes. We've even seen more of a shift of groups going, traditional C-class owners going to B-class because there's just really not that much of a difference in a spread. And as long as the money is as cheap as it is, that's what we're seeing. And the coastal markets that you mentioned, people are fluctuating out of there, but there's a lot of crossover like the Midwest and Southeast. A lot of groups can own in those markets where they're targeting the Nashvilles, the Charlottes, the Atlantas of the world. Well, they're getting priced out of those. Those are sub 5 caps. Those are 4.5, maybe 4.25 on some of the stuff. So they're coming here. So 5.25 in Cincinnati looks amazing, and especially as cheap as debt is, it's hitting investor returns. If they're looking for 6, 7, 8%, whatever it is, cash on cash, however they're solving to it, or low teens IRR, it pencils out. And there's often times where you're looking at some deals that are sub 5 cap, and they actually pencil out because the debt is just so cheap at that point.
One thing to just quickly add to that too. I think that the capital that is coming into the market, which has always happened, but some of the restrictions and rent control, which we might talk about later too. But I think that I know I've gotten a lot of calls. I'm sure Nathan has as well, where New York, based guys, California based guys that, are restricted in what they're capable of, pushing on the rent side. So they're gravitating more towards our markets, along with, slightly higher cap rates as well.
Yeah, I agree both with Kurt and Nathan's comments. We're seeing institutional players come into the market, and they've got so much capital and they have to deploy it, and that's driving prices up. So we can comp pretty much any property right now. I talk to both of those guys regularly, and we talk about values and underwriting and all of that. And we're not having an issue comping appraisals right now on acquisitions, in large part because of the institutional players and outside investors coming into the market, driving prices up. They can afford to pay a little bit more than certainly some of the local people would like to pay. So that's been great. We've actually seen appraisals come in significantly above purchase price on a few deals. I had a very unique deal where the lender actually asked the appraiser to revise the value down closer to the purchase price because it was so much higher. So it's unusual that you would see that, but my client obviously got a great deal, but also that a lender would ask to have a lower value. So I think that's an interesting story, but it's also a good example of what we're seeing in the marketplace right now. Cap rates, are still being driven down. The only thing that we saw with appraisals at the beginning of the pandemic was the appraisers were putting in a COVID rider type paragraph where they were saying, here's the value subject to the current market conditions. However, we realized there's a pandemic going on and this is subject to change. So fortunately, nobody really had to look back to that and say your valuation needs to change.
Yeah, I think Kurt brought up a good point too. I mean, cap rates aren't, just based on the interest rates that I mentioned. It really, Kurt and I can promise you, we'd have a conversation with a new person from New York or California every day, looking to buy. Buyers, they're not the issue. I mean, finding money to invest in Cincinnati is not the issue. It's just the supply and having realistic buyer and seller come together, and that's just creating more demand in the city. I think there's a population shift as well, whether it's COVID, it's rent control, and just really livability of cities. I mentioned the Nashvilles and Atlantas and Charlottes of the world. Like, I think those are, say the primary targets, and then they shift into these secondary markets like a Cincinnati and our surrounding markets. So it's a common trend. I mean, I don't know how many times I've heard recently, groups that are, I've only owned in New York. I've lived there my whole life. I own in New Jersey as well. I've never thought I'd be in Cincinnati looking at deals, or Columbus or Louisville, whatever it is. And that's a real conversation that happens almost every day. And I think that's just a positive sign for markets like Cincinnati. We're just going to continue growth, and not just investment, but population and jobs. And I think we're going to continue seeing that.
I actually have an investor question for you guys. From an investor standpoint, are you seeing more investors come into the market for existing properties that may have previously been upfront working on, say, the development of new properties, just because it's getting so much more expensive to develop new properties, with the cost of lumber, for instance, increasing by 50% last year? It's just getting way more expensive to build new properties. So are some of those investors that may have invested and on the upfront now looking to acquire properties instead?
Yes. Yeah, we've seen that. I've seen multiple groups that were development focused only that have now shifted and are looking for existing product, just because the challenges that you mentioned earlier, John, just with how long a development deal can take at times. So the ability to grow the way that they want to is challenging, along with construction costs and things of that sort. The other thing that I would add to that is, I know you're in the affordable space as well, but we have seen a lot of market rate buyers that are now gravitating and more interested in the affordable space that previously weren't, just for the same, kind of the same reason. They're looking to grow, they're looking for product, they're looking for ways to take advantage of, maybe a product type that they don't think there's as much competition, which typically there is just as much, but we're seeing that as well.
John, I think what we've seen the last few years is a huge flight to this value add type of deal, right? Everybody wants a value add. And I think in large part that has to do with cost of land increasing, development costs going up, lack of contracting available, and labor costs going up, and now certainly lumber. So groups who were developers are looking for creative ways to find product and still add, some sort of redevelopment or value add touch to that instead of going ground up.
Yeah, no, that's definitely interesting, because it's something that I think we're dealing with is, kind of some pullback from investors on that side of things. So that's, we don't necessarily hear that on the development side, coming from the broker side or the financing side. So that's interesting to hear. It's kind of figured.
We do have a question from John Rickert. It's a series of questions. So it is in relation to our topic about cap rates. So the low cap rates that we're seeing, are they subject to interest rates remaining low? And how much risk does rising interest rates add to the transaction? And how does that affect the terminal rate, cap rate, excuse me? And are buyers underwriting an exit cap that is higher than the interest cap? That is a long laundry list of questions. And maybe Kurt can start us off in regards to how investors are underwriting these deals, and if there is an exit cap that's higher than the interest cap.
So yeah, I guess a loaded question. I think that what we've, going in a cash on cash return or a cap rate going in, it kind of is what it is. Obviously that can be impacted if interest rates do shift, but I don't, and Noah could speak more, and Tracy, but I don't think, interest rates, no one foresees them, making material shifts in the next 12 to 18 months or probably even longer than that. But on the backside of things, I think what we have seen on an exit cap analysis, more of an IRR driven, solving for an IRR, we have seen groups get more aggressive with exit caps. I would say, in my opinion, maybe they would say not, but I think, combining that with the potential for interest rates to go up at some point in time. So 10 years from now, nobody knows where the world is going to be. And if you're buying at a 5 today, a 5 cap going in, and your exit is a 5 1/4 10 years from now, that could be pretty risky, because the reality is that if interest rates do go up, values at some point in time are going to have to shift and adjust along with it. So I think that could create some issues with exit strategies, whether that be a sale or a refi, and especially too with a lot of buyers with the amount of interest only that they are getting. So it could get, I guess, interesting. And on top of that, we talked about value add. If they're not hitting the rent projections on their value add program, we'll see. But I think that could create some issues down the road potentially.
Yeah, I agree.
Go ahead.
So, yeah, like Kurt said, I mean, those are a great answer. Cap rates are going to go up if interest rates do. I mean, I don't think we expect that in the short term or anything material. But with these IRR calculations, it's always a fun calculation, because people know exactly what the cap rate's going to be in 7, 10 years. So when they're adding only a few basis points, what really are you calculating or basing that off of, besides really a gut feeling? Maybe a 1% increase just to be kind of conservative in what we're seeing, but can you sell at a 6 cap if rates in 7, 10 years are 5.5? So it's interesting to see. The IO is another big thing, especially if you're not hitting your value add targets, you're not building any additional equity principal pay down. So that could cause some issues down the road.
One of the things that we're seeing, not so much from a cap rate, but from the interest rate standpoint, is we're starting to see some construction deals where obviously we're on interest only as far as during that construction, but they're going ahead and executing maybe a 2-year forward and stuff and locking in their interest rate via swap as far as for the balance of maybe up to 10 years and stuff. So they're taking that risk out, because I think everybody kind of looks at it now and says, okay, we believe that interest rates are going to go up, but nobody really knows how far and how fast. So they're just taking that piece out of the equation, and a little easier for the banks from an underwriting standpoint, because then, we're comfortable, takes the risk out of the equation as far as what's going to happen to rates, because we already know what we're locking in at during the life of our loan.
Yeah, John, this is a great question. And there's been a lot of talk recently about rates potentially rising. People are watching inflation. The Fed has obviously pumped a ton of money into treasuries and into the marketplace over the last 10 years, and even more so in the last year now with the pandemic. So there's definitely a lot of people watching that closely. I've read articles recently where people are predicting interest rates to rise sharply over the next 2 years. We don't predict interest rates because we're going to be wrong. That's just not something we do. What we do advise our clients is to take advantage of the low rates right now. What we're seeing is that you can lock up to a 30-year fixed rate at around 3%. HUD FHA is even under that. So a lot of people are taking rate risk off the table by going long, 10, 15, 20, even 30 years fixed. We have a couple of life companies who can do a 40-year fixed rate. That's a long time, but if it's a generational family asset, why not take advantage of that right now? There's opportunities to go cash out down the road, et cetera. But it's a great time to go long and to take that risk off the table. But also, if you lock up for 10 or 15 years and rates do rise, now you've got a loan that is valuable because it could be assumed at whatever the rate was locked in at, 5 or 10 years ago, and looking at maybe a supplemental piece to bridge the equity gap down the road. So we're definitely seeing investors going longer, again, 15, 20, 30-year fixed rates. Fannie and Freddie look heavily at exit cap rates. That's something that they base their initial loan proceeds, loan to value on, but they also will structure interest only with looking at an exit test. So if the loan's not paid down by a certain amount by the end of the term, whatever their projected exit cap rate is can affect the interest only period. So a lot of things in play there. But again, rates are historically low right now, and investors are taking advantage of that by going out 15, 20, 30 years.
Noah, a question for you on the agency side on Fannie and Freddie with their exit caps. Is there any, I guess, color you could provide on kind of how they're coming up with that, cap rate, I guess, and calculation?
I don't know the answer to that, Kurt. I do believe it varies from market to market. So if we're doing a deal in Cincinnati, it's probably going to be more aggressive than Dayton or Lexington. If it's in Dallas, or Los Angeles or New York, it's going to be more aggressive than Cincinnati. But unfortunately, I don't know the answer to that question.
All right, we're coming up on, we got about 10 more minutes here. So again, I just want to encourage the audience to ask more questions. Thank you, John, for your questions. And just wanting to remind everyone that we are ready to answer any questions that you guys may have. But one of the biggest questions that I have for the audience while we wait for additional questions to come in, what are the challenges that you guys are going to be seeing or predict what challenges you guys are going to see over this next year? We've kind of alluded to, interest rates maybe rising over the next couple of years, but over the next 12 months, what do you guys see being the biggest challenges for the multifamily sector?
From the development side, honestly, it's construction costs. They've gone up so much, and predicting out, even building new projects, we want to make sure that we are budgeting accordingly. And right now they've just been jumping all over the place over the last year. And so, trying to forecast what actual cost is going to be both for, projects, a few months down the road and projects that are just getting started has been very tricky just because there's been so much fluctuation in the market as far as where those costs have gone. Interest rates definitely have helped offset that, but it's one of those things that has certainly been a challenge.
John, how many of your projects have been delayed because of COVID?
So all of them in some sort. Yeah, I mean, we've got projects, ongoing where we certainly have had shutdowns with, one of our subcontractor crews, somebody has COVID, and so we have to shut down for a couple of weeks. And, it's kind of a, it's a life cycle process. We have to get certain aspects of the job done. And so if you, break part of that chain, then the whole project gets pushed out. So it's, I don't know, we probably have about 20 projects ongoing, and some of those have certainly been delayed at various levels. Luckily everything is on track, but from a standpoint, from a development standpoint, we've been, everybody kind of understands, the COVID issues. And so it's one of those things, even though, everybody wants to see it get done, everybody's kind of understood the challenges. And so we've been able to work with banks, lenders, sellers, everybody to kind of get pushes from a timing standpoint, if there's have been COVID issues that have arisen.
The one thing, and not really on the brokerage side, but I guess operationally, as talking with owners, I think to keep an eye on is just the one area that has seen some challenges is some of the urban markets. With COVID and social unrest that's been going on, we have seen occupancies and rent growth slow in more of the urban core areas. So I think keeping an eye out on how those come back to life, hopefully here this year as things improve. But that's the one area that is seeing some challenges.
Yeah, overall Cincinnati multifamily saw an increase in rent last year, but for the urban cores that Kurt mentioned, there's a decline, and I think that's more of a nationwide thing. You're just seeing everywhere. I do think that's more short term. It's going to bounce back, hopefully. I mean, there's been so many great things that have gone on in downtown Cincinnati and surrounding areas. I would hate to lose that momentum. So I think and I hope that's short term, but other challenges. With stimulus money is eventually going to run out, and we've been pumping trillions of dollars into the economy. Luckily, that's helped, rent getting paid. That's been a big reason why we don't have much collection or bad debt increase from the last year. So, is that our jobs going to come back and be fully consistent before that runs out, and how that's going to affect the multifamily space? I think we're in a good position for that, because I mean, housing and shelter will always be a basic necessity. So, that's a priority in people's lives, and it's a good investment to be in. But I do have concerns about when that runs out and how inflation may kick in.
Yeah, and I'll definitely, to weigh in on the urban suburban thing, the kind of the hopefully that Kurt and Nathan mentioned has been tricky from a development side, because while we also do think the urban areas certainly will come back, nobody has been, well, I wouldn't say nobody, but people certainly have been much more hesitant to jump in and commit to any sort of financing or working on those new projects, on those urban projects. And I don't know what it's going to take as far as to kind of get over the hump. I don't know if that's going to be, 3 months, 6 months, a year from now, but I think even though we're certainly very bullish on the urban side of things, it's just definitely been a lot trickier from the development side to work on those new projects. So I honestly do think there will be a slowdown on some of those new projects that we'll see over the next, couple of years, at least as far as new projects coming to market, just because you have to get a bank or a lender or investor willing to commit to financing on those projects. And if they're not willing to do that, not willing to take the risk, which, lenders and investors typically are more risk averse, then I think we'll certainly see a slowdown on those sorts of projects, and much more on the suburban side, because certainly the fundamentals have been better there, in this current environment.
I'll piggyback on with what John's saying in terms of, as far as the urban product itself is definitely something that the banks will look at more conservatively. I think everybody's still interested in them. I think a lot of it is kind of a wait and see approach, given as far as there's, no businesses really downtown right now. Everybody's working from home. We've seen a lot more in the way of concessions on the urban product as far as in the suburban product. So yeah, it's definitely looked at and viewed upon as far as more conservatively. But I think that will come back. It's just more as far as a matter of time. In terms of challenges, I would say for the coming year, more on the bank side is probably more or less gauging that bucket that I talked about, and measuring that in terms of what pays off and what comes on, because there is a tremendous amount of product. I mean, I don't know if anybody listened to Dave Lockhart the other day and listened to all the development deals and stuff that are in the pipeline. And he only touched on some of them, and a lot of them are 300 plus units per project. So there's a lot of product as far as it's coming on. I think for Cincinnati, I think we're very lucky from the standpoint of having Amazon, and I'll call it the Amazon effect right here, because I think that will continue to bring jobs as far as to the marketplace. And obviously, what's the one thing that we all look at in multifamily is, what are the jobs? That's where we're going to get our people as far as to live in those units. So I think that will probably be the biggest challenge for the banks. I think the demand is still strong for Cincinnati's multifamily market to continue to build. And if you look in terms of where the majority of these projects are, they're in great locations. The demand is there. There's reasons as far as for that project to be successful in those locations. So kudos to all the developers out there in terms of the projects that they're doing, because they've got great sites, and I think the projects will be successful. But I think that's probably the biggest challenge as far as on the lending side, as far as for this coming year.
Yeah, real quick. One of the reasons investors love Cincinnati is because of its stability. We don't have the big swings like we see on the coastal markets and some other markets. So, we're slow and steady. Rents increase steady. One thing CRANLEY touched on earlier is that population growth has been a challenge. And even though we're drawing new employers here, we're seeing employers leave as well. And that's been a bit of a challenge. in terms of new product, we don't see any issues with lease up or anything like that, but I do think it's a challenge for some of these deals to hit the projected rent levels in certain markets. There's competing projects going up across the street or around the corner from each other, and it's going to be challenging to hit some of those projected rent levels that we're seeing, particularly if we can't bring more jobs to the area. One of the biggest challenges we are seeing right now, and this mainly affects, C-type properties, is the inability to evict people. And until that changes, there's going to be some softness there with rent collections and delinquencies. But otherwise, I think it's full steam ahead for the multifamily market in Cincinnati in 2021. As I mentioned earlier, investors really want to be here, and we're seeing more and more out-of-state and institutional investment come to the market every day.
Great. Anything else you guys want to add to the challenges? Well, we are coming up on our time. So again, thank you to the panelists for taking time to be with us today and giving us some insight of the market. And thank you to the audience. Well, John, for giving us a couple questions for the panelists today. And again, really appreciate your time. And I will turn it back over to Todd to go to our next panelist. Thank you guys again for the opportunity.
Thank you.
Thank you.
Thanks, Jessica.
Thanks, Jessica.
Awesome panel. I'm really starting to follow multifamily all over the nation. It's really going to be interesting to see how this plays out when the moratorium's lifted and B and C and Class A rents and people moving around. It's going to be a fun part of the industry to watch. Hopefully more winners than losers. Well, so if you're on the next panel, now would be the time to activate your camera. I turned a couple people's cameras off, so if you're having trouble with your camera, I'll go through here and try to get it started. But again, real quick, want to bring your attention back to our virtual lobby here. Here you can see this panel that's coming on. Below that, you can see what they're going to talk about. But here's the way that you can connect with each of these panelists by using the LinkedIn button. Say hello. Feel free to continue using the chat room. Love that. Let's just check here quick. I know that there's not me, Todd, but another Todd that I had to turn his camera off. Let's see. Here we go. Get that going. And okay. All right. Well, gentlemen, Chris, you're the moderator.
I am indeed.
And it's all yours. Take it away. I will be in the background if you need any help.
Great. Thank you, Todd. Good morning. My name is Chris Nachtraub. I'm with Lee & Associates, and I have the honor of moderating this next panel. We're going to discuss a few things today. One, starting with the government's involvement in commercial real estate, and then we're going to check in with a number of experts who represent the different asset classes, and then spend some time contemplating the future of the industry. I think this is going to be a very interesting conversation. I'm going to go through one at a time and give each of them an opportunity to present some information on their particular area of expertise. And then we'll come back in the end for some follow-up. So if you have some questions, please hit them via the chat room and we'll try and get those to our panelists. So I will quickly just introduce everybody to you. Our first contestant is Craig Miller. He is the president of Duffy & Duffy Cost Segregation. He's a certified public accountant, a chartered global management accountant, a certified government financial manager, and a certified cost segregation professional. He is a former tax commissioner agent for the state of Ohio. He serves on the State of Ohio Board of Directors of NIOP and serves on the NIOP Commercial Real Estate Finance and Tax Subcommittee in Washington, D.C. He is a frequent speaker on cost segregation for the National Business Institute, the Ohio, Michigan, Pennsylvania CPA societies, and has published numerous articles in CPA and other industry trade publications. Craig is one of these really smart people who have more letters after his name than he has in his name. And I demonstrated my math skills by actually counting them, and so that is true. Next, we have Steve Laughton. Steve established Equity in 1987. Since that time, the company has become a leader in commercial development, construction, brokerage, and property management. Equity has a robust history in most real estate product types with an emphasis in healthcare, retail, and office. While Steve provides leadership to Equity at an enterprise level, he provides direct management of the firm's development activities. The expansion of the firm to 7 cities across the country is due to Steve's focus on growing the company. Steve has been very successful all over, and today he is joining us all the way from Columbus, Ohio. Next will be John Gartner. He's a principal and senior vice president with Colliers International in his 28th year. He specializes in industrial institutional leasing and sales, ranging from Northern Kentucky to Dayton. Beyond his many hobbies, he is most proud of his family, his wife Camille of 25 years, son Jack, who is a college junior, and daughter Maggie, who is a sophomore at Elon. His favorite community participation is with St. Vincent de Paul. John has been doing this a very long time and has probably forgotten more about industrial real estate than any of us have learned. Next will be Josh Rostein, who has been with Onsite Retail Group since 2013 as a listing specialist, focusing on retail and restaurants, primarily working on behalf of landlords and developers. He has established himself as an Instagram influencer within the commercial real estate industry under the account of @SpaceForLease, and has seen great success in generating business, furthering connections, and enjoying global industry insight. I'll let you all put that into your phones, @SpaceForLease, the number 4. Josh is a lifelong Cincinnatian, and he has a 17-month-old daughter. He currently resides in Oakley. Josh's grandfather was actually a very successful and well-loved retail broker here in town. Josh, maybe someday your daughter will be taking over for you. And last, two more. Todd Pease Jll. Todd is based in the Cincinnati office for JLL, has 20 years of experience in greater Cincinnati real estate. Prior to joining JLL, he spent 10 years working for Duke Realty. This has given him a very unique skill set, including local and national market knowledge, project leasing, construction estimating, budget creation, acquisitions and dispositions, and overall real estate portfolio analysis. A sample of Todd's recent landlord developer clients include Hines Oaktree, North American Properties, and Al Nyer, and he's represented little companies like General Electric, American Standard, and Pilot Chemical. Todd, you forgot to mention, I think the very first broker deal I ever did representing an office tenant at Triangle Park some 20, however many years ago. I think you were 15 at the time. And last, but certainly not least, is Brady Mick. Brady is Director of Strategic Design at the architecture firm SHP. Brady focuses his 30-plus years of professional experience on providing workplace studio clients with design strategy and leadership, whether that entails creative and analytical thinking, research, or the future of social dynamics. Throughout his career, he has published over 50 articles in professional journals and industry trade magazines, and has been named a top-rated faculty member within the core NAT MCR workplace curriculum 14 times. I just met Brady actually this week. I find him a very interesting person. He spends a lot of his time thinking. He's kind of the Jack Hanley of architecture. He's thinking some really deep thoughts, and we're going to benefit from those today. So let's jump in with the questions. Again, starting back with Craig. Craig, leaving politics out of this, should they or shouldn't they? Without question, the actions of government contributed to the upheaval in the real estate market last year. What has and what is the government doing now to help those in our industry who are suffering?
Thanks, Chris. Can you hear me okay?
Hear you fine.
Before we get into the slide, which is up on the screen, I just want to say how optimistic we are, and we should all be in the state of Ohio about the recovery that's hopefully going to come this year instead of next year. The experts were saying all during 2020 that recovery was probably not going to come until 2022. I think everyone saw the governor's announcements about the curfew and about some relief for restaurants that were effective beginning today. You know, Ohio was very strong coming into 2019. Ohio was in the top 10 states in the country in terms of direct spending, commercial real estate, total output, salaries and wages, and jobs supported. And all the experts are predicting that the states that were in the best position in 2017, 2018, and 2019 are going to recover the fastest and the best. I'm optimistic that the rental and housing markets in the greater Cincinnati, Northern Kentucky market are going to be strong. The last panel had some great insight and optimism. You know, Cincinnati, Forbes magazine and Wallet Hub continue to rank the Cincinnati market as strong because it's a good marketplace, it's affordable, and a good economic environment. So together with the fact that the state was well managed and we've got a lot of smart people that live, work, and play in our state, together with some federal and state government assistance, I think Ohio is gonna recover quicker than a lot of other states. Besides all the stimulus acts and relief you saw in the CARES Act and the Consolidated Appropriations Act that were passed in 2020, there's some new legislation just being introduced now in Washington. In fact, on February 4th, Illinois Congressman Schneider introduced a bill specific to retail revitalization. And what this new proposed bill would provide for is for REITs who have struggling tenants in retail space, the ability for a REIT to raise their equity ownership in their tenant spaces from 10% under the current rules and regs to 50%. It would also update related party and REIT subsidiary rules, and all this would result in an immediate injection of capital from the private sector, not from the government, but from the REITs into their tenant spaces. So stay tuned to see what happens with that. A new bill is also going to be introduced as it relates to energy efficiency measures. We already have the commercial building tax deduction incentive that Congress just made permanent in December, but a new EQIP legislation would specifically target energy efficient retrofitting in buildings 10 years and older and getting a faster write-off. So stay tuned for news on that. If you didn't see, the SBA is giving 6 months subsidized loan repayments for loans tax-free. That was in the Consolidated Appropriations Act in December. And then I can't overemphasize how important the CARES Act 5-year NOL carryback is for net operating losses for all businesses, but especially for commercial property development and ownership, and the ability to carry back losses that were incurred in 2020 up to 5 calendar tax years and get tax refunds, and in some cases get refunds of taxes that were paid at the much higher corporate and individual pass-through rates when the rates were higher prior to the 2017 tax bill. And then quickly, the state of Ohio incentives. The governor in December signed Senate Bill 69, the tax credit for transformational large mixed-use development projects, which is a 10% tax credit. We did also see some legislation that would provide for real estate property assessed valuation tax relief on appeal. That bill died, House Bill 751 in committee in December, but expect to see that revisited in 2021. And then piggybacking on the federal opportunity zones, Ohio adopted and the rules are out, and the state began accepting applications January 1st through February 1st to get the additional 10% tax credit for Ohio Opportunity Zone investments for stock qualifying businesses, partnerships, and for real estate. So all this should set Ohio up for a faster recovery in 2021.
Excellent. Most of us belong to some different trade organization, IOP, OMA, ICSC, Mortgage Bankers Association, other advocacy groups, and obviously they're been advocating on our behalf. What are they trying to get past right now?
So if we could go to the next slide. So there are some very large and powerful lobbying and advocacy groups, some working in conjunction with one another and others in opposition to one another. I'm happy to report that for the most part, the U.S. Chamber of Commerce and all the commercial real estate and business lobbying efforts have had some success over the last 10 or 15 years as it relates to fair taxation. We saw the Opportunity Zone legislation and the forgiveness of tax on cancellation of debt and favorable capital gains taxation, trade investment. If it weren't for the advocacy efforts of all the commercial real estate organizations, we would not have the historic tax credit incentive, which returns anywhere between $6 and $8 per tax credit award in the form of private investment based on independent case studies and surveys. Without advocacy and lobbying efforts in Washington and in the state of Ohio, other programs and incentives to create jobs, create investment, build the tax base, right? Those of us in commercial property ownership and development are job creators, and we build the tax base and grow real estate taxes. We're willing to take on redevelopment of difficult projects, some of which are brownfields. You know, by estimates, NAIOP in Washington estimates there are 479,000 undeveloped contaminated brownfield sites in the United States. And they're going to sit vacant unless the dollars work. And like it or not, sometimes the government has to step in and offer some incentives to make redevelopment a reality. Favorable depreciation since the Tax Reform Act of 1986 has been under fire from the Committee for Responsible Federal Budget and others over the years. But all these bullets that are on my slide here, these are all things that without advocacy at the national level, these are going to go by the wayside, and that could spell bad news for jobs and investment and the economy.
Excellent. Well, it's nice to hear that our dues are being put to good use. All right, I'm going to ask you to think about, and we'll come back in the follow-up, just maybe some free CPA tips you can give us on how to increase cash flow in this rather difficult time. And now we're going to move over and we're going to talk about the healthcare segment of commercial real estate. And Steve, are you there? Yes. Could you just generally describe the healthcare real estate asset class? What all does this encompass?
Sorry there, Chris, I had to get unmuted. Yeah, the healthcare asset class, a little more diverse than a lot of the things we do in commercial real estate. It's fairly broad. It's, you know, most people think of the healthcare asset class as a medical office building, either on a hospital campus or out in the suburbs. And that is a core piece of it, but it's also morphed into what we traditionally would have thought of as retail spaces. We've developed retail strip centers with 75 to 80% of the tenancy being healthcare. And those are the uses you've seen expanding dramatically the last 10 years: urgent care, lab facilities, lab draw, chiropractic, dental, that sort of thing, that are now very much forward-facing, consumer-centric uses that need the same thing retailers do, you know, access, visibility, signage, and all that sort of thing. And then there are special use facilities, which you see popping up a lot, also largely in retail locations like freestanding emergency departments and so forth. And then the most divergent piece of it, of the asset class, is really a residential product, multifamily residential, and that we call senior housing facilities. And those are largely, again, multifamily residential facilities in which we vend healthcare services. So pretty broad space.
So COVID was a medical condition. What impact did that have on the healthcare segment?
Well, you know, initially, it was not all that different than all the other segments, right? I mean, healthcare offices, medical offices got shut down by the state of Ohio. Other states were in, like everything else, and even had a special call out in the legislation, the emergency legislation in most states, including Ohio, where elective surgery and those types of things were completely, they actually called it a moratorium. You could not do those things. And that was because the feeling at the time, not knowing what was coming, is that we would need all those resources to treat COVID patients, which at least in Ohio never really materialized. But again, they were shut down for that same 6-week period that pretty much everything else was. So that was initially a little scary and dramatic. It recovered extremely quickly. You know, the interesting thing is the restaurant you didn't go to or the movie theater you didn't go to during that period didn't create pent-up demand for you to go to the movie theater or go to eat that meal you missed in March. Healthcare is not the same. You don't go to healthcare locations because it's fun. At least I don't. And I think one of the greatest misnomers in the industry is elective surgery. I mean, how many of you guys have gone to have surgery because it was something to do? Maybe I'll go see a movie. Maybe I'll go get my knee replaced. You know, it isn't like that. So the point is that all of that shutdown all that demand never went away. It was pent up demand. And we've seen that flowing through the healthcare system here the last 8 or 9 months. And pretty much in that regard, a full recovery of the industry. I can tell you we're getting all of our rents from all of our healthcare facilities across the country. Never had any real delinquency there. So it's fairly healthy sector now.
You and I are talking over a computer. I know that my mother-in-law talks to her doctor on a monthly basis over a computer. I'm curious what impact telehealth has on the real estate segment.
Yeah, I mean, people tend to equate it to like e-commerce effect on retail segment and so forth. It's not really that. It's just easier access, like with your mother, right? The easier access to healthcare. There's very little that's done in a medical office building that can be done over telehealth. Greater access, ease of access actually creates greater utilization, which is probably good for the collective health of our nation. It's a reimbursable visit for a doctor now the last several years. In fact, telehealth, like e-commerce, has been around for a long time. It's been in fairly regular use for nearly 10 years. So nothing new, accelerated it. It's used more. Quite honestly, it usually precipitates an office visit because, again, you call the doctor up, you talk to him, you tell him you have 104 fever, you have chest pains or whatever else. He's not going to just tell you to take an aspirin and go to bed. He's going to tell you to get into a medical practitioner where you can be evaluated. So very nominal effect from a real estate perspective. It's not going to reduce the demand for healthcare real estate space.
So what does the future look like, both here in Cincinnati and national?
Well, you know, it's an interesting thing. Healthcare really is a national thing. You know, we look at all of our markets and Cincinnati's no different. You know, we moved our company into healthcare specialty back in '93, way before it was popular. And that was based on the new term back then, the graying wave of America. We were looking for something in commercial real estate that would be fairly recession resistant. And so the graying wave was the baby boomers, this giant, the biggest demographic bubble in the history of the US and the most affluent bubble in the history of the US. And the irony is back then, the graying wave was like 33 years old. So I didn't have gray hair back then, but that's all changed. And what that predictive piece of that demographically was that demographic, the baby boomer, was going to spend more money every year for the remainder of their life, more money literally year to year on healthcare. And that has come to pass, and that isn't going to change. The baby boomers don't time out and all die out till, well, hopefully 30 or 40 years. So we got a long run of ever increasing healthcare spend. So very, very bright future. We saw that play out during the Great Recession. There are only 2 industries in the United States that grew every single quarter of the Great Recession. One was education because it's government funded. The only private industry that grew every single quarter was healthcare.
Wow, something to think about there. Thank you very much. Speaking of growing, we'll now move over to Mr. Gartner, and who's going to talk about what's been going on in the industrial segment. Can you give us an overview of what 2020 looked like? Look at that.
Yeah. Chris, first of all, thank you for hosting this. I appreciate you being the guy who's stepping up to run this and head panelist here, or head moderator for us. Josh, funny watching you here. I used to work with your grandfather, who Chris mentioned. He was, Mort Schwartz was truly the consummate gentleman. Showed up and looked like Chris Knockjob right now in a suit and tie every day, and he'd probably be very proud of you right now. With that being said, that's the stuff you say when you're 30 years into this now. But so where's industrial been? You know, we're the sweetheart, I guess, as you'd call it. And but fortunately, we've remained stable here in Cincinnati. To follow up on what the last panelist said, we continue to remain stable, and we hear how things really are going really, really well for industrial. When you look overall on how 2020 wrapped up, we had about 3 million square feet of positive net absorption. I don't want to waste a lot of time on this, but this is how people talk about where we fit into the market. And when you look at a regional basis, Columbus did 10 million, Indy did 10 million, Louisville did about 8 million. So why is Cincinnati not seeing that? That's a really good question. I think what has kept us from growing is we have a lot of really, really, really big bombers that have been built over the last few years, which have driven our vacancy up from the lack of big users that have entered our market. It's kind of interesting how people talk when we're at 6% right now in our vacancy. And when you go back just 2 years, we had double the amount of absorption, which equated to about 3.5% vacancy, 250 bip drop from where we are today. So what does that mean? What that means is we have recently seen a lot of product come on the market down in Northern Kentucky and Northern Cincinnati over the last 2 years. Many of those spaces are finally getting absorbed. We do have a couple good stories to tell coming up of a 1 million square footer that's about to be taken down, a 600, and several other ones that are going to create a really, really good story for 2021. Everybody seemed to survive very well over 2020. We had our minor blip of what everybody went through, dealing with your tenants, dealing with your landlords. What's remained consistent, and I talked to my friends over at, say, Prologis quite a bit because they have an interesting story from all the acquisitions that they have done of buying other REITs and acquiring large bulk product. They have maintained it, like Dukes and Van Truss and North Points and everybody that we deal with are still maintaining, say, 95, 98% occupancy within their portfolios. What they see shifting is what happens on retention. And what's happening on retention is going from, say, 80%, it may be dropping down to 70. And that's a shift that we're seeing, which appears to be positive, even though it shows a negative number, because what's happening is we continue to see that growth happening within tenants in the market needing more space for many, many reasons. So with that being said, shifting off the bulk and that, I would go over to where do we stand with, if you could just, we won't address this slide right now, either one of these. If you could go back to the second slide, whoever's, yeah, let's leave it there for a sec. What we forget about here is what's going on with the rest of the world, because we have 280 million square feet, and this only equates for 70 million square feet of that. So what has happened inside of the bread and butter of Cincinnati, from our manufacturing, our light industrial, you know, everything that runs up and down this corridor, is things could never have been better for people in the freestanding building market. My good partners, Chuck Ackerman and Bill Kiefer, and their new entree, Jeff Kroger, you know, we have, and Aaron Casey and my partner and I, we sold a lot of buildings this year. We have seen record increases in price per square foot. We're probably seeing over the last year 20% growth in freestanding sales. I'm not sure how the appraisers are keeping up with these in order to get them appraised, because we're just continually reaching and achieving higher numbers for these buildings. They are still well below, I don't want to say well below, but they're still below replacement cost, which is helping what's drive this. But at the end of the day, we are in desperate need for buildings, freestanding buildings. Once they're like houses today, once you see them kind of hit the market, they typically go pretty quickly, Chris. So we've, you know, we're stable, we're good. We have a lot of activity going on. There's nothing bad to be said about our industrial market. And I see that going forward. So.
I'm just curious, you mentioned Prologis and Ventrust and a lot of these bigger institutional players. How do they look at Cincinnati compared to some of our competing cities, Columbus, for example, or Indy, or down in Kentucky?
I was just on a national call the other day. They look at us exactly the same as they look at those other markets. They continue to grow, they continue to develop. We've seen numerous new entrees into the market. We don't have enough land. That's going to be the impact of northern Cincinnati and northern Kentucky. We're just really running out of sites, and people are reaching and pushing sites that were never developed before, developable before, and now taking down those sites. You know, our market has changed. And if you go down to Walton, Kentucky, and that's 18 miles south of the river, we're now at the Dayton going 60 miles north. So our marketplace has really become an 80-mile swatch up I-75. What we haven't seen in the Dayton market is we have not seen spec development. Norm Corey and myself work with Opus. We are going to work on a smaller speculative development up there. And then there's a couple others that are working on developments up there as well. And hopefully we see more spec, because we're desperately going to need that as we run out here in our northern Cincinnati market. Institutional players, they still cannot get enough of this. If you go back to 2011, we were talking about this the other day, we were at 7.5 cap rates here in our market. And while people still love the coast, they can't get over themselves on the coast. We are now trading institutional product here in our market at around just sub 5, which we have never seen. I remember getting into business years ago and some guy was driving around with a 10 cap license plate. Well, those are certainly days gone past. And, it's the guy I was pitching to the other day, he told me that Northern Kentucky would never get below a 7 cap. And here we are positioned in hopefully a portfolio at a 4.9. So the institutional market loves us here. They can't get enough of buying it. They can't get enough of building it. And we really just need to really make our market fantastic. We just need a few big users come in and take down some space. Yeah.
Okay. Excellent. We'll come back with some follow-up in a little bit. Let's move over to the world of retail. Josh, are you there? Come up. Excellent.
Yes.
So in our retail world, Josh, we did not see 3 million square feet of positive net absorption last year, and it might be a while before we do again. Obviously, COVID, one of the hardest hit segments of the commercial real estate world was retail. Give us your assessment on COVID's impact on retail real estate.
So like Frank Sinatra once saying, if you can make it in New York, you can make it anywhere. If you can make it through COVID as a retailer or restaurant, I think you're also poised to make it in this world. Got hit super hard, and my job day to day is handling space that's available for landlords and developers. So come COVID, right around April, we had a whole slew of opportunities. However, there were not as many people out there to absorb these spaces. Generally speaking, in my world, there's nothing more attractive than a fully equipped restaurant space with a hood, with furniture, with a liquor license in some cases, patio seating. But with COVID, none of that really seemed to matter. So the reality is that even before COVID, a lot of these users were sort of hanging on by a thread, as it were. Labor was expensive, good labor was harder to come by, food costs were soaring, and it was hyper competitive. I would even go as far as to say that we were straddling that line of oversaturation, especially as it relates to restaurants. So in my opinion, COVID really just accelerated the inevitable and slashed a lot of these folks that were hanging on by a thread anyways. And the sad thing is that our society has really hugged the idea of shopping local and supporting small businesses. And unfortunately, those were the folks that really got eviscerated during COVID. And no amount of support or GoFundMes would really help. Even if they were in a position to reopen after everything got sorted through, a lot of their staff had to go find other jobs to support their families. So what we saw is a lot of space being dumped on the market, but it wasn't all doom and gloom, because there were still some operators out there that were not forced to resist the expansion, and they looked at this actually as an opportunity to capitalize. So with a lot of spaces being available on the market that came fully equipped, it really became a tenant's operation to go and find the best possible locations and fill in some holes that they had in the market. And they used the period of COVID to strategize, to wheel and deal, to plan, so that come right around now, they're in a position to open. And hopefully, especially in light of Governor DeWine's announcement yesterday that our curfew is lifted, we've been behaving, they can all now go out and tackle the market as they wanted to. The most interesting thing, I think, is, and the lesson from COVID, is how these users were forced to pivot and adapt. And we all saw some really interesting elements being introduced to us as consumers that I think we enjoyed, that were born from the necessity. One, are these concepts of streeteries. As the Cincinnati folks can attest to what we've seen in Over the Rhine, they have closed off alleys and some streetways to provide for increased outdoor seating, which really made a dynamic experience for diners and consumers alike, which has been really cool. Another thing that we saw is restaurants like Jeff Ruby's, they had these to-go meal kits so that you could, while you weren't able to enjoy your meal inside of one of his restaurants, you could pick it up and go feed your family and do your best to substitute that experience in the comfort of your home. A lot of the restaurants had to really lean into technology if they weren't familiar with it before, creating a platform that anybody from 9 to 90 can go on their phone and order their food and go pick it up seamlessly. So a lot of these restaurants had to slim down their menus, create meals that were more simple and most cost effective, and that transported well, things like sushi as opposed to cheeseburgers, which can get soggy by the time they've arrived at the home. But a lot of these restaurants now, while they had to do that to survive, they're still incorporating that facet of their business today so that they have yet an increased line of revenue that they didn't realize before.
Excellent.
Let's see what else I have here. Go ahead, Chris.
Yeah, I just, what we're seeing at least now, and by the way, your Frank Sinatra reference has moved you into the position as top panelist, but so what are you leasing right now? Who's taking retail space?
So like Steve said, medical is huge. Dentists, urgent cares, chiropractors, just like he said, they need all the things that historically retailers needed: good visibility, access, signage. They want to be where the vibe is, so that people, while they're going to get their goods or their groceries, they say, oh, wow, I didn't realize there was a chiropractor here. Restaurants are still doing deals, but their footprints are smaller because they don't need to accommodate as much dine-in seating. We're doing deals with tobacco and liquor stores. As you can imagine, they did just fine through the pandemic. I guess there was more of a need for those kinds of things. And then the family entertainment world, that has seen a nice little boom here, at least in our market, giving the parents things to do with their kids, giving the adults things to do when everything else is closed. So we've seen growth from those components.
Okay. I cut you off before. You were mentioning something that might intrigue a few people, the concept of a ghost kitchen. What exactly is that? And do you have to no longer be living to enjoy it?
Yeah, so ghost kitchens basically, let's see. So Thunderdome Restaurant Group, who has the Eagle, Maplewood, Bakersfield, Credo, et cetera, they have a restaurant in Deerfield Township that was, I think, right around 5,000 or 6,000 square feet, closed during COVID. Instead of reopening it as the restaurant that it was, they said, look, we already paid for this beautiful restaurant. We have a fully equipped kitchen. Let's use this as effectively a commissary, not have dine-in service, but prepare foods, because a lot of people, especially with DoorDash, Uber Eats, and the like, they became accustomed to going and having their food picked up and brought to home. So what they did is they reproduced their Eagle restaurant offerings, which you can only get in Cincinnati. You can only get it in OTR, and it's now available in Deerfield Township, Mason, so that they're not only stretching their brand to a completely different market and covering that gap, but they're utilizing a space that may or may not have worked the way that it did prior to COVID to keep it profitable. And ghost kitchens are becoming more and more common as bigger restaurants are not being refilled.
Excellent. Thank you. All right, we're going to move on to office now and talk with Todd Pease, who looks just like he did 20 years ago when we did that big deal at Triangle Park. Todd, you're in there with retail and the impact that COVID had. So tell us about the office market in 2020.
Thank you, Chris. And can you hear me okay?
Hear you fine.
Okay. And I would like to mention that you actually look better than you did 20 years ago when we did that massive deal at Triangle Office Park. Well, thanks for doing this, Chris. And, I apologize for my background. I was unable to download my beautiful JLL background. So you've got me coming live to you from the Pease World headquarters in Marymount, Ohio. Our office building is actually having some electrical difficulties. And this is a perfect example of how we've all been able to adapt. If this had happened to me 2 years ago, who knows? I'd be on the phone with IT trying to figure out another way to call into this meeting. But we're all able to adapt now because of COVID, and my 9-year-old daughter helped me plug in here. So the overview, kind of the office market in 2020. Surprisingly, if you look at the statistics, we were actually flat. So we didn't have, I think, Class A, I'm looking at the numbers here. Class A was 0.09 absorption, so a negative 0.09 absorption. So not even a full, tenth of a point in negative absorption. I'd call that flat. The average asking rents have not really changed on the Class A and Class B side. So really, we kind of just punted our way through the year, and it's been relatively flat. I will say, the overall impact is yet to be determined, and we can get into that. But at this point in time, kind of first quarter 2021, what I'm seeing is a lot of what I'll call pent up decision making. So some people have pent up demand. The medical folks, they didn't do any elective surgery last year. Now they're starting to do things and come into the doctor's office. With us, it's more of a pent-up decision-making. So depending on the industry type and the business strategy, real estate strategy for that particular client, they're now kind of, at least in my opinion, making decisions. So some are saying, let's put this whole space on the sublease market. Others are making long-term commitments, especially in the IT sector. A lot of internet security companies are really thriving right now. They're growing. They want to hire for obvious reasons, and they want to attract and retain talent. And so they're not blinking. As a matter of fact, these guys are going, into this as seeing it as an opportunity to lock in office space at a good rate and serving long-term deals, 7 and 10-year deals. And this is happening kind of all over the market for me, frankly.
Interesting. So tenants right now, their lease is coming up within a year. What are you seeing? Are they renewing long-term to try and negotiate a better deal? Are they just terminating? They just kicking the can and saying, give me a 1 year. I don't know what we're going to do. What's the activity?
It's a combination. Like I said, some are just punting and saying, that's probably a majority of the tenants out there are saying, let's see what happens, because everybody, for the most part, has a pretty positive attitude that we're going to come out of this. Things are going to look different. So, but we are going to come out of it, and there will be a need for office space. Again, different tenants have different opinions depending on their people and what they're trying to achieve from a people standpoint. What we've really found is it starts with the people. And so certain tenants might say, let's just punt and let's do a 2-year, a 3-year renewal. And most office landlords, if there's no TI involved, are happy to oblige. But again, others are seeing it as an opportunity, doing long-term renewals and locking in at good rental rates compared to what they were seeing over the last few years. So kind of a mixture of things. And then the sublease market has been pretty active. I mean, there's a lot of available sublease space that's move-in ready and has beautiful furniture, and you can move in tomorrow and be up and running, which creates an opportunity for other companies.
I can look at Reed Hartman Highway out my window, and there is not one car. Oh, there's one car driving down Reed Hartman. I mean,
yeah.
People are not coming to work. So who's leasing office space now? You mentioned IT, but are there other industries, and what type of space are they leasing?
Yes, good question. The logistics companies are still rocking and rolling of all types. That's a really hot segment, and they're all looking to hire kind of and retain good talent. And so with that, I feel like the IT folks, the medical folks, as was mentioned earlier, the logistics firms, and then the traditional firms like accounting and finance and financial advisors. I mean, these are all traditional firms that need space. Attorneys, the attorneys, they might work from home some of the time, but they really, in my impression, really seem to have a need for space. And so, to answer your question, those are the sectors that remain active, and there are others, but they're looking to places that are to landlords that are, first of all, well-heeled and financially, firm. The big players, Hines, Oaktree, the stable landlords, Daimler out of Columbus up at Liberty Center, locally North American Properties. These are well-heeled landlords. So people want to be where it's stable, kind of like we saw back in 2008, 2009, where there was instability in ownership due to some of the TIC funds. People are looking to a stable landlord. That's kind of the first thing. The second, and probably the more talked about item, is cool space and amenity laden space that's secure and easy to access. So, mixed use projects were hot and exciting before all this started. Liberty Center, Newport on the Levee, Kenwood Collection, and not to mention some of the more prominent office parks like up in Mason and Westchester, like at Center Point. But I think the whole talent war is still happening, and I hate to call it a war. The talent, trying to get the best talent and retain the best talent is still the key driver, and people need a reason now more than ever to come to work. They have an option now. They can work from home part of the time, depending on the company. They can also come into the office, and that changes with who what the company is all about from a real estate perspective and a people perspective. But to give employees and potential employees a reason to come in, and their clients to come into the office, meet with them, come into the office, meet with their teams, and give me a compelling reason to come in today. It's easy just to get up and keep your pajamas on and log into your laptop, but we really are seeing that. And I always, Newport on the Levee is a perfect example of that. That's a turnaround story with North American Properties, which started just before COVID, hit pause, due to, as did everyone. And now they're unleashing their construction, and we're seeing a ton of activity down there. I mean, and that's the reason people are moving out of the boring office building buried in the back of a park, and they want to go to a place where they can be noticed by the public and they can do the best recruiting possible. So sorry, that was a little long-winded.
All right, appreciate the info. Glad to hear you're getting some deals done, and the other occupants of the Pease World headquarters will continue to eat. We'll now move on to Brady Mick. As I mentioned in the introduction, Brady's a director of strategic design, and I just met Brady this week, and he's a very interesting guy. He spends a lot of time just thinking, and I think that's something we all could be doing more of. Brady, one of the themes that we've heard today is that COVID simply accelerated what was already happening in all these market segments. So we were already on a path. Walk us through that journey leading us to today.
Well, it's interesting when I listen to the colleagues here and the points they make in their specific markets. I have some key words that came out. Craig talked about strength into the future. Steve, you mentioned diverse and morphing as key words in the healthcare industry. John, you talked about stability, but growth, change in the industrial market. And Josh, you talked about reshaping something that was, quite frankly, already suffering, retail, and was well publicized before COVID. And Todd, you hit many good points about looking at people from a different standpoint and the cool factor and other things. So sometimes as we're sitting in this moment and sometimes spinning, frozen over what to do next, there is value in looking backwards. There were some things that were already going on, Chris. I think just a few of them just off the top. knowledge work had matured. Knowledge work had matured. And the proof point of that is that teamwork had surpassed individual contributors. Because many individual contributors were, second point, replaced by technology solutions. I'm a writer. I used to use a ghostwriter regularly because my technical writing is shit. So now I've got Grammarly, which does all that for me, right? Immediately on the fly. So all those sorts of aspects of being an individual contributor have been melded over by technology, which has also untethered us from place. Used to be, not everybody. These are all spectrums. Each one of these things I say. Collaboration combined with innovation before COVID. Innovation was in just about every branding tag somewhere in an industry. And we were getting close to cracking that nut on what that meant to place. All industries, all factors, what innovation means. Culture was catching up with efficiency factors. And Todd just very clearly stated that with the cool factor. And what does that mean? You know, what is the importance of place to people? And most importantly, I think teams are already complex. They were already working across multiple domains, across multiple sorts of interfaces with technology, virtual, physical. One of my favorite things was to ask a team I would be interviewing, who's your boss? Who's your boss? And very rarely in the last decade have people been able to point to one person. So that the matrix nature of work has taken control. It's taken control of everything in our lives. All these things were in place, which is probably, if you think about it, one of the reasons why minus the shutdown, the shock of the shutdown, that fear shock moment, which we've all expressed, which was real. Nobody seems to be complaining about productivity. And that was kind of one of the past myths that we've broken, isn't it? You know, I have to see my people. I have to know where they are, put them in a basket and put them all grouped together. And we've finally broken that myth. We knew that a long time ago. So those are some of the things that I think that allow us to understand where we came from. Chris, does that help?
It does. So here we are. So what's next?
Well, again, I think the clues are in a lot of what our colleagues said here to us. There does seem to be this trend towards distribution over centralization. It was there before. I've been doing this for 30 years now too. So, you know, there's always this thing that goes on in business. Are we centralized in one hub, or are we decentralized? Well, it seems to me that decentralization is the future. And I think it's within many of what these folks have said about where we're going to go and how we're going to combine things together. And that's the other thing, is it's going to be blended. It's not just retail centers that are life centers. It's learning. It is productivity, it's thinking, it's socialization, it's sustenance, it's work. All these things are going to eventually, you're going to be asking, where's my office? And I think for a segment of us, we can already say it's everywhere. I think we can do that. I think that's fair to say. My office is everywhere. I go where I need to go in order to be the most productive with my team. One more thing is that there's been a lot of talk recently about hybrid models of work. That's coming next. Okay, I get it. You know, hybrid basically means we're going to be working part-time over there, and we're going to be working part-time where I'm supposed to work, old world, where I'm supposed to work, in my office. That's a hybrid model. A lot of questions surrounding what that place looks like when it supports that. Really, I think we need to be talking about an ecosystem of joining all of these industries together, work, learning, retail, healthcare, industry, everything is going to interrelate and rely on each other to form a new value proposition, which is innovation. We have a lot to decide yet on what that means from a business standpoint, and a lot to decide on what that means to an environment. But Chris, we know a lot. We know a lot about what drives human behavior in environments. We just have to utilize it, bring it to the forefront. Again, does that make sense?
Yeah, narrow that down for us to commercial real estate. What does that look like?
Well, I guess I would do it this way for us. If you think about, okay, I'm gonna build an office. In the traditional, I'll use that word lightly, traditional world, the way to plan that place would have been to look at three key components of productivity. And we call those things offices, workstations, and conference rooms. That's what we call them. Those three components are basically the table stakes for what a workplace environment would be. If we're going to narrow it to something that has future longevity and viability, I think first of all, for the time being, while we still have this pause, that Todd established, there's still a freeze. Leaders seem to be stuck. Analysis paralysis or lack of data. There's something going on that most office places are sitting on ice, waiting for people to return. But I think we do need to add what we knew before about activity setting work, pre-COVID activity settings, diverse places for multiple uses, usually ad hoc, usually heavily community-based in some way, shape, or form. Sometimes we got as mature as if you live in a big city and you have familiar with the idea of the quiet car on the train. All the train cars going into the city look the same, but the last car is 100% quiet for your focus work. Not allowed to talk, not allowed to listen to your radio, and everybody knows it. It's a socially controlled car. It works. I've been on one. Somebody got a phone call and everybody stared at them until they left going into New York City. It really works. So anyway, we start to bring these principles of design back into the new natures of work. I think we can do a lot about narrowing it to some very strong, predictable outcomes today. I have one more thing, Chris, if I may. I'm greatly concerned about this freeze. And just a silly little analogy to try to express this concern that I personally feel, and a lot of my colleagues in strategic design across the nation, we're all relating this, is, okay, so just play with me for just a moment here, guys, just play with me. So think of your bedroom, everybody, when you were 12. Just think of that space. When you were 12 years old, probably still had some toys or a closet full of games or drawers. I had junk drawers. I always collect things. So anyway, junk drawers and maybe posters on the wall. And just for a second, pretend like you went away to school, high school and college. And you didn't come back to that room until you were, say, 21, and nothing had changed. You're back to your 12-year-old bedroom when you're 21, and you're looking around going, well, this isn't right. This is environment shock. I'm going to make some changes. Now add one more thing to it. Suddenly you're 21, you've had these life experiences, and your parents still expect you to be in bed by 9 o'clock. That's culture shock. And that's what I fear. If we return to these environments that are cube-based, office-based, conference room-based, and all the management systems that we remember, then we're probably going to feel a period of great discomfort and isolation between, and we are going to return, guys. Space matters. We're not going to reduce the need for any of these markets in space. Maybe retail changes because of the distribution systems that are coming in place and technology. I don't know that, but I think the nature of space is going to change, but the need for quantity of space is going to remain. It maybe grow, I hope. So Chris, I'm looking back at you, my friend. Am I making any sense?
Absolutely. I appreciate those insights. I want to throw something out to everybody here. In all of our disciplines, we've got antiquated real estate, some old big box retail spaces that nobody really needs anymore, or a 70s office building with small floor plates, or a warehouse with low ceilings. What do we do with those? How do those get repurposed? Can we turn a big box retail into an industrial space? It's got a good location. Can we turn office into residential? Craig, are there any government incentives to repurpose this real estate? What do we do with all this product out there that isn't really meeting the needs of today and certainly not of tomorrow? That's a general question.
Well, Chris, this is America, so we tear all that stuff down. We don't reuse anything.
Repurpose through good design would be my first suggestion. There's all kinds of factors there, but have to have a change in thinking, don't we, Steve? We have to think differently about, I think, Josh, you had it, spaces that are ready-made with infrastructure for a new program, a new purpose. It was in your presentation of ideas, wasn't it?
Yeah, shopping centers are the obvious candidate here. All these big boxes where stores are all, think Best Buy, Bed Bath & Beyond. People can buy these items on their phone. So you don't need the retail store to function also as a distribution center. You need a distribution center that Mr. Gartner is going to find for them. And then you have satellite locations. So what do you do with these shopping centers that are otherwise well located, easy to get to, have a ton of parking? One thing that I see is you do blow up part of it, but you create more of that live, work, play dynamic. Because if you can dump a density into the project that's either office during the day, residents at night, then you have the demographic there that can service the retail that remains or the restaurants that could also be there. So just Brady, like you've been saying, reimagine and reconfigure, but the real estate will probably always be good dirt on which the properties sit. Just reimagine what the buildings are that sit on top.
Yeah, I want to jump back in on that too, Josh, because you made me think about it a little there. Steve, when it's good bones, that's a design term we often use. When it has good bones, when it has structure and has infrastructure and it has character and many things, of course, that have been built out there in my 30 years in this profession of design probably could be torn down. Is that fair to say?
Yeah.
Is that too damning? A lot of it's crap.
And I agree with Josh. It's really mixed use. We've done some of that. You know, we've repurposed. Gosh, when Blockbuster went out, we snapped up probably 30 of those and turned them into urgent care facilities because they're perfect location. That's a simple example. The big box or the abandoned mall, of course, is the real white elephant out there. But we've seen some success with that too, and it really comes down to mixed use. You get rid of that ginormous wasted parking field and put apartments on it. You downsize the retail space. You mix it up with some healthcare and other community needs, and can work out pretty good.
Yeah, Steve, I totally agree with you, and I love Josh's example of Thunderdome and the ghost kitchens. That's like the perfect example. They immediately flipped that and turned that into an opportunity up in Mason. And I think to Steve's point, and really to Brady's too, these big boxes, and Josh's point, these boxes are in like Tri-County Mall is in a wonderful location, right? But it's struggling right now. But think about how central that location is to literally everyone in our market. And it's got a huge structured parking. It's got massive parking ratio, and you know, whether or not you knock that whole thing down or repurpose parts of it, you can create something new, maybe that we don't even know about right now. But if I'm thinking off the top of my head, based on what we all know today, one thing we hear in our industry is the 18-hour day. And so for people, so like you live somewhere, you go to your retail somewhere, and you go to your workplace somewhere. That is something that all the mixed use guys that started talking about a few years ago. Well, everything has been accelerated. There's been gasoline poured on the fire because of COVID, and we've all kind of fast forwarded. Everybody's trying to hit the pause button, but this has also fast forwarded us all to have to make decisions and adapt. And really, I'll go back to the point I brought up earlier. We're adapting to from an office space standpoint to adjust to our people, which is the number one priority. You want to have the best employees, and you want to have them as efficient as possible and as effective as possible. So companies looking for, I'll call it office space, but it's really whatever you want to call it. It's the location in which you're going to attract and retain the best people. You got to make that compelling. And there's a creative something in there that all of us can work off of, whether it's industrial or retail or medical or office. And Tri-County Mall is a perfect example because it's a great location. So something's going to happen there.
Yeah.
I just got the sign that we got 5 minutes, and I got about 20 minutes worth of stuff I still like to talk about. One question that came in from the audience, just asking about flex space. Is it seeing an increased demand since they don't have the common areas? John, I mean, what are you seeing in the flex space market?
Well, I'd love to have my partner Aaron Casey, you know, dubbed the flex queen for many, many years around here, but you know, it has remained stable, Chris. You know, there's actually conversations now down in Northern Kentucky about building additional flex, and it all comes down to the same problem that we've always had: is dirt's really expensive. The cost to build those buildings is very expensive, and we haven't seen the rents in place to help justify all those costs going into it. So I think we'll have to wait and see what's going to happen, but any flex has remained stable, and anything in industrial, like we already talked about, has continued to just skyrocket in value. So there'll be a time and place, but it's consistent now. Yep.
Okay.
I'd add to that, Chris, on the development side, it's to echo what John said, it's virtually impossible to develop new flex because you can't make the numbers work. You either got to be a huge bulk warehouse or something much, much smaller. It's really, really hard to make those numbers meet.
Excellent. Craig, we haven't heard from you. Anything else you'd like to add before we log off here?
Sure. Ohio's done a pretty good job. Ohio's population is now at about 11.7 million. I want to say it was around 8 million in the 2000 census. Ohio's home to 20 Fortune 500 companies, 8 of which are in the greater Cincinnati area. Businesses and real estate are going to do well when government stays out of the way and government is there when we need government. And location and education and recreation and job opportunities are going to come when states, Ohio regularly ranks in the top 10 or 20 in many, many different categories. So I'm happy to be in Ohio, and I've been in Ohio in my whole life. And, like I said earlier at the intro, I think Ohio is going to recover faster than, probably 30 or 40 other states.
We all share in that hope. I mean, one key takeaway from me here today is that now more than ever, we are all connected, no matter what the discipline, and our success is going to require all of us strategically working together, moving commercial real estate forward. And we're all fortunate that there are some great people in every segment of our industry, and we'll have the opportunity to continue to work together. So with that, I will turn things back over to Todd. Thank you very much to all the panelists. That was really a terrific conversation. Go sell something, guys.
Love it. Good stuff. Real quick screen share here. This is our next panel. Downtown Suburban Developments Game Changer Projects. Looking forward to hearing about this. I think 2021 is going to bring some cool stuff to Cincinnati. So if you're on the next panel, now's your chance to activate your microphone and camera. I'll help here in the background if you get stuck, but just make sure I got everything I need on my end. John Rickert, you are the moderator. I will leave it to you. Let's see, make sure you're there. There you go, John. It's good to see you again after a couple hours of panels. So take it away, my friend. It's all yours.
So let me see if I can get my screen share going. And hopefully, can you tell me if our slides are up?
I don't see them right now. If you have gray in your beard, like you and I, we get a pass. We get like 5 minutes to try to bring up slides. If you get stuck, holler. I can. I think I have them on my computer too.
Katie.
There you go.
Okay. So
I'm looking at a blank screen though.
You are screen sharing. How's that?
There you go.
Okay. So one of the things that I think is interesting is what a tremendous segue from the last panel to this panel. And Todd started by talking about, please give me a reason to come to work, and was talking about competition for talent. Josh Rostein brought in the live, work, play dynamic, and Brady certainly brought home the changing look of our spaces, talking about multifamily, hospitality, retail, entertainment, and reimagining what real estate looks like. Our panel today is game-changing developments in the region, and our speakers are each doing very large projects in the Cincinnati area, having to do with the District of Clifton Heights and the Digital Futures Complex and College Hill Station. Our themes for our panel are partnerships, public-private partnerships, stakeholders, and then the transformational impact of the project. But I think in all of that, it comes back to having a place where people want to be. Our first panelist today is Peter Horton. Principal of Terex Construction, who will be presenting the Digital Futures Complex. Peter and his partners founded Terex in September 2014. And since starting Terex, Peter has worked on some of Cincinnati's most high-profile projects, including the Uptown Gateway, Children's Theater, and On the Lateral. Peter, would you like to kick us off?
Sure, thanks, John. So let's jump right into it. Digital Futures Complex is the project that I'd like to share today. It has been known by a couple other names, but the most prominent was the Uptown Gateway that John just mentioned. We recently, in our continued alignment with our partners in Uptown, have rebranded the whole site as the Digital Futures Complex. It is an incredibly complicated project that started way back in 2015. So we've been working on this for more than 5 years, but there's a lot of stakeholders, as I'll review today, that have worked on this project for much longer. And I don't just mean our site, but I mean that just the region in general has had so much attention, emphasis, and just a lot of passion that is driving the change that we're seeing there along the Martin Luther King Drive interchange at I-71. So it's not possible to do without great leadership. And so on the right-hand side of the screen, you'll see kind of our leadership team, I would say, from a development side, but from a design side, and certainly not least the financing side, because it is a challenging environment to get these projects done in right now. Albeit I share the optimism of a lot of the presenters today that things are changing for the better. This is one of my favorite views of our project. It shows kind of a street level view of what the project will look like when fully completed for Martin Luther King. But in order to really understand this project, I want to take a half step back. And so, John, if you could go to the next slide. I'm going to talk first about the Cincinnati Innovation District in general. The Cincinnati Innovation District was formalized. It's been a long time coming, but it was actually formalized in March of 2020, last year. So right as the pandemic hit, which was unfortunate because there was so much energy and momentum being built around the Cincinnati Innovation District. It was awesome. This slide here kind of shows you kind of the geographic reach from I-75 to I-71, with that MLK corridor kind of being a common thread that links the two sides. But what's amazing, and what Cincinnati is, I think, has always recognized, but I think people outside of Cincinnati are now realizing, is the amazing institutions that we have really clustered in a very small amount of space. So led by the University of Cincinnati, which is a Carnegie one, tier one research institution. And then just how amazing it is to have an institution like Cincinnati Children's Hospital. We talk a lot about these institutions. They come up in a lot of other discussions that are, goes on and on. But between these two institutions, they combine right now for almost $500 million in research generated a year, which is just absolutely phenomenal. And then you've got all kinds of other major institutions from Cincinnati State. You've got the zoo that's doing a lot of stuff. You have UC Health. You've got Tri-Health. You've got NIOSH, which is coming online. So there's a lot of major employers doing great work and research in an already defined area that is now being overlaid as the Cincinnati Innovation District. So I wanted to start there. We're going to be focused on the right-hand side of this district, near the intersection of Reading and MLK. And if I could have the next slide, John, I'll kind of dive into that. Now, go back 2 slides. Okay, so the Martin Luther King and Reading Road cross section is kind of the epicenter for at least the new development coming out of ground, right? So there's kind of 4 quadrants there. There is the the quadrant we have, which we call the Digital Futures Complex. And then we have, John, maybe you could advance one. And then there's NIOSH, which is on the back one, John. There you go. The NIOSH is on the other corner. You've got Nair Properties that is in Culcarney that are doing one on the northeast quadrant. And then you've got the fourth quadrant, which is probably the furthest away, which is on the southwest quadrant. But when it's all built out, it's going to really be an amazing main kind of epicenter of this new Cincinnati Innovation District. So our project is, as I already shared, the Digital Futures Complex is roughly at 8.5, 9-acre site that sits effectively in the southeast quadrant. But we have the benefit of being between Reading Road and I-71, so some great exposure and frontage there, as well as being on the south side of Martin Luther King. So today I wanted to at least give you the quick overview. A lot of you have heard this before, but it is our phase one of our project, which is under construction right now. If you were to drive by today, you will see steel the steel framing that is getting that is being constructed right now. And I think we're at about 3 or 4 stories right now with our steel. We will top out sometime in March, and then that's when the exterior and the core and shell of the building really goes together. So phase one is 3 buildings. It's the UC Digital Futures building, which you see the steel coming out of the ground now today. It sits right on the eastern side, fronting I-71. Then there's the Digital Futures 2 building, which is really meant to house the corporate partners for the project and those that have interest in being co-located next to UC. And then we have a hotel. All 3 buildings are roughly the same height and similar in square footages. All of that is kind of set on a single podium, which is aligned with the same elevation of Reading and MLK intersection. And we have about 3.5 levels of parking underneath that will provide roughly 1,400 cars to support the phase one. Next slide, please. So what's amazing about this development is just how many twists and turns it's taken. And you know, if you were looking at a site plan from 3 years ago, you're like, oh, it really didn't change that much. It has changed so much, and maybe not in footprint, but certainly in terms of design and overall the look and feel of it, but also in terms of how we've kind of advanced how this will all work when it's up and running and fully functional, right? So in this image, you'll see on the right-hand side, the lighter gray building is the UC Digital Futures building. The dark gray is the speculative office and research building that will come up right next to it. Even the shapes, just the way they kind of interlock with one another, it's all very intentional. And another great intention here is to really have an activated plaza level for the connectivity of all these 3 buildings as part of phase one. So think about it as more like program space, kind of like you would see in Fountain Square or Washington Park. I mean, it's really meant to be an active and engaged site that is not just buildings conveniently located next to each other, but it's really going to be a programmed experience. So I've listed some of those features on the right-hand side here. So just going to kind of get a feel for what I'm talking about. There are also, because UC is our anchor tenant, they bring a lot to the table in terms of some of their corporate partner advantages and access that tenants will have. You'll be able to get on a shuttle bus and go over to campus. You'll be able to use the rec center. There's all kinds of things and corporate partner benefits, I would say, to be located here. And there's going to be amenities day one, but this is the cool part is that, you know, once this district, not just our project, the district gets built out, it's really intended to be a 24/7 work, live, play, learn environment. But our project just happens to be the very first example of that, or the very first purpose-built development coming out to support the Cincinnati Innovation District. Next slide, please. So I share this slide as well, not because there's too much to look at, but I think but there's a lot to look at if you really start to get close to the screen and understand the type of activities that will actually happen at the Digital Futures Complex. And so this specifically is a section that's cut through UC's building. And I like it because it starts to show people that, yes, the first floor is a lot of common space, and there's a conference center, and there's a cafe, and there's a lecture hall, and there's all kinds of really great shared amenity space on the first floor. But it also happens to be where they have their two-story lab spaces. So UC really wanted to be able to do drone labs, and they wanted to have flexible labs to do things like automotive. And so this rendering starts to show what some of that could be. And then floors 2 through 6, as you go up the building, is really a mix of labs. And in this case, you see a robotic lab in one, but the idea is it's project-based space. So a mix of lab space, collaboration space, and office space mixed on each floor. And some of those might take the full floor. Some of that could just take a part of a floor. But it's really where the academic side of what UC brings, and all their talented staff and faculty members and researchers, all their talented students and their corporate partners will come together and work on innovation together. And whether that's a drone or whether that's a software or whether that's, it's meant to be flexible and adaptive and change and continually change. Some projects may go 6 months, others may go 6 years. So it's really meant to be an adaptive building that really continues to be the crossroads of where the academics meet the business world. Next slide, please. So getting to this point, and this is another huge piece of this project, I wanted to just take a minute or two to talk about what it takes to do something like that. I mentioned before, people have been pushing this idea of innovation corridor for 15 or 20 years in Cincinnati, right? And you had a lot of people that were instrumental in getting all the ducks in a row so that the interchange could actually happen. And it was, Uptown Consortium was a big push, the community of Avondale, the city of Cincinnati. I mean, there were so many stakeholders. And when you are that invested in making that much change, that physical change for a neighborhood, you tend to stay invested. And so these stakeholders now want to see the fruits of the labor, right? And so there have been so many involved people just to get to where we are that it would be irresponsible for us to not to engage those stakeholders and understand their position and bring their perspectives to what we're trying to do. Now, on the lower left, I say there's an impact at that early collaboration, and it is fantastic. One, you just meet so many people in the process, and you get so many great perspectives and interesting viewpoints. But it allowed us to actually formalize some things like a community benefits agreement to really kind of outline or I guess set the table for some rules of engagement. And it was meant to do not just for our project, but it was meant to be done as a benchmark that could be a template to follow for future projects that happen within the Cincinnati Innovation District. So we got great feedback from the community early on. Avondale was one of the very first meetings we took as we were pushing forward with the site back in 2015. And there were some things that they said right off the bat, like, hey, we don't want to see another parking garage. We see enough of those. But this was a community that said, we know change is coming. We're excited about that change, but we just want to be part of the conversation of that change. And so that's been our mission, is to keep it as open and collaborative as we can. So based on that, we do have monthly meetings with all the community stakeholders. It is driven to a lot of different places. We've had a lot of mentorship. We've had a lot of great workforce development. We have a lot of outreach sessions, and all that is in the goal of getting complete engagement, so that at the end of the day, it's a project that everyone is proud of, not just the developer, not just the University of Cincinnati, but everyone in that community can be proud of. So the CBA objectives, which I think are interesting to share. I won't spend time reading this whole list, but you can see that for the pre-construction and the construction, and we have some goals to hit, and they were very aggressive goals, and we've worked really hard to hit those. It also was true for the investment side of what we did. We wanted to make sure that minority investment had a chance to participate in this project. And in post-construction, a lot of CBAs say, what's your minority spend up to, get the project built. But we also said, what's it going to be like after the project is complete? And finally, and I think one of the best parts of the community benefits agreement is this tenant education or this tenant awareness piece. And it doesn't have any metric tied with, I guess it's 100% participation, because what we're saying is every tenant that locates here at the Digital Futures Complex will go through a tenant workshop. And that workshop requirement will foster engagement. So it is about, while we couldn't say what inclusion goals certain tenants had to meet, we couldn't ever go on the hook for that. But what we could go on the hook for is said, well, you will meet with the community and you will understand the impact that you're going to have by moving your business here. And that also fosters great communication so that open dialogue starts to go. And this is one of the parts of the CBA that I think will be the most exciting piece. So I'm running short on time here, but let's go. I think I have one more slide. Yeah. And I just kind of wanted to give you just a quick snapshot of our phase one, what the total economic impact was. And so for phase one, when complete, it will be about 470,000 square feet. That was done with an investment of nearly $200 million, $40 million in infrastructure improvements, full-time jobs. When the buildings are occupied, we're anticipating up to almost 1,500 jobs. Construction will have created about 450. And then, the economic impact to the community and back to the city, creating $1.47 million in annual real estate tax increment. And then just on the earnings tax alone, $3 million plus. But probably the best stat out there is to get to this point, 26% of our dollars will have been spent with minority spend and 6% with women business enterprise spend. So a lot of information, and I think if there's other questions, we can go over it, but I think that's later, maybe in the slide, and I'll turn it back to John.
Wow, that was an incredible presentation and incredible slides, Peter. We will do questions at the end. I want to make sure that each speaker has enough time. Our second speaker is Aaron Bartels, presenting the District of Clifton Heights. Aaron is the Senior Vice President of Development for Trinitas Ventures. Aaron's the Senior Executive for the District of Clifton Heights, a joint venture partnership between Trinitas Ventures and Crawford Hoying. Aaron, I'll bring up your slide.
Great, thank you, John and Peter. That's a tough act to follow, but appreciate the opportunity to join Peter and Amber, and thank Real Estate Journals for hosting and giving us the opportunity to share the district at Clifton Heights. Trinitas Ventures is a nationwide builder of university-centric real estate. Our communities typically sit at the intersection of campus and community. While we build a mix of uses, anywhere from residential or partnering with others on retail, hotel, office uses, we know that ultimately we serve a mix of users. And so bringing that broad mix of diverse users, including local residents, students, employees, and visitors to the market is really what helps define our district platform for mixed-use development. We're very excited to have announced that this past November, we've entered into a joint partnership or joint venture with Dublin-based Crawford Hoying to advance in co-investing and developing the district, and really look forward to bringing a high level of excitement and energy to this gateway opportunity. So, John, if you could flip to the next slide, I think, really sort of starting with the context of what's existing or what was existing, we Trinitas in 2017 acquired the Deaconess Hospital. It's a 700,000 square foot complex sitting on 8 acres, had been largely vacant and closed for several years prior to our acquisition. Over the last 3 years, we've engaged very, very closely with the local Cuff Community Council, with the Clifton Heights, Kirk, the local business association, city staff, stakeholders, really with the goal of envisioning how this gateway property could be transformed within the Clifton Heights neighborhood. In July 2018, we hosted a week-long community-wide charrette. So basically had an open design studio with our master planning team, really starting with a blank slate, a survey, and a general development program, and 3 primary goals that we knew within the community were key priorities. So those were really focused on maintaining open and transparent community engagement with the local stakeholders and the community council, knowing that we would be creating a dynamic destination serving Clifton Heights as well as the broader Cincinnati market, but more importantly, reinvigorating the economic vitality in this important location, in this historic neighborhood, creating employment and economic opportunities in Clifton Heights. So the image on the screen here of the existing hospital showcases the scale, the density of what was, but I think more importantly, really highlights what was not. And when we look at it, you know, it lacks that pedestrian activity that would define an active street and urban environment, lacks some of the architectural character, the diversity of uses, the eyes on the street, the sky bridge in the background, you know, really pulls those pedestrians off the street. All of those elements contribute to great urban design and, at the end of the day, successful real estate opportunities. And so we knew that this could be a much better opportunity and provide a much better dynamic destination for Clifton Heights and at the gateway to the University of Cincinnati. John, if you could go to the next slide, please. To really kind of showcase the outcome of our charrette, again, really informed largely by that local input, that open design studio. We developed a conceptual planning framework that balances that mix of uses and users. We've created and are curating, merchandising an active urban street. So it's a rare opportunity for a developer to step in and essentially merchandise or curate both sides of an active urban destination, especially at the gateway to a world-class university and institution and historic neighborhood like Clifton Heights. So our planning framework brings in that mix of uses. It serves that mix of users, introduces the diversity of architecture and uses, all with a focus on pedestrian and multimodal access. Clifton Heights sits at one of the highest points in Cincinnati, and we know that the height that we're achieving, and really informed by input from the local community, takes advantage of the phenomenal views of downtown, overlooking the river valley and back into campus. So the master plan that was developed, that came out of the planning charrette and was ultimately approved unanimously by City Council, provides for a broad mix of uses. So what's shown in white is our existing Beacon. It's 1,000 beds of student housing that we opened in 2019. Our next phase will include development of Block A immediately to the east. It'll feature 1,100 beds of student housing, 170 key hotel, Crawford Hoying, with 20,000 square feet of active street level retail. And we're targeting to begin that construction later this year. So that will essentially define that intersection of Clifton Avenue to the east and Straight Street, and round out development on the north side of the street. On the south side, what we call blocks B, C, and D will include up to 400 units of multifamily and 200 units of senior housing. So again, bringing that mix of users to the market, to this gateway destination for the community. Block E, over to the west across the street from the Deacon, is already under construction by Peter's team from Terex, and will be the future home for the Tri Delta sorority house, housing 30 student members of Tri Delta. So that's actually a very important element to this plan. They currently exist on Clifton Avenue. So we entered into an acquisition agreement, purchased their existing sorority house, and they're moving forward with building a new sorority house, relocating later this year to free up the opportunity to develop the hotel. And then if you could round out on the next slide, John, I think, really summarizing one of our major development goals, as we pointed out, was reinvigorating that economic vitality in the market. So the district is the largest private real estate investment in Cincinnati. $475 million will be invested by Trinitas, Crawford Hoying, and our partners, and will ultimately be home to over 3,000 residents. The district provides 1,200 construction jobs and will provide over 800 permanent jobs. And at the close of development, we'll bring close to 2 million square feet of development activity to this location, generating over $10 million in tax revenue locally. We are very, very proud of the work that we've done to date. We're very proud of the interaction, the transparency, and the collaboration that we've had with our local neighbors and leaders. And we very much look forward to bringing new life and vision to this location and bringing that community gateway to the University of Cincinnati, to Clifton Heights, and the Cincinnati market as a whole. Really, really thank you again for the opportunity to share our development. Look forward to carrying on the conversation. Thank you.
Great, thanks, Aaron. Super slides, and we certainly appreciate it. Our last speaker is Amber Seeley Marks, presenting College Hill Station. Amber is a real estate development professional specializing in affordable housing and community development projects. Amber joined Penrose's Cincinnati office in 2019 after working a decade on urban redevelopment in post-Katrina New Orleans, which I think is incredibly interesting. At Penrose, Amber is responsible for developments from pre-development through construction and lease up, and we are looking forward to hearing about College Hill Station. Amber?
Thank you. I'm having some computer issues, so I've got my airport traffic director headset on. And in case you're curious, this coming Tuesday is Mardi Gras. So, but unfortunately it's called off this year. So I'm going to bring you further north in Cincinnati from where we've been talking so far up to the College Hill neighborhood. And wanted to talk a little bit about our partners before we get into the specific real estate projects that we'll be talking about. At the bottom of the slide, we've got our partners. I'm Amber with Penrose. We're the developer for the project. And our key partner and really the driver for this development has been the College Hill Community Urban Redevelopment Corporation, or CHURC, and the City of Cincinnati. So we're excited to be kind of working together with those partners, and then the finance fund is an investor, and we've got lots of other folks participating in that, but they're an equity investor. Next slide. You can see a little bit of where the property is located. So the street going north-south is Hamilton Avenue, and the street going east-west is North Bend Avenue. So the property sits on two corners of this intersection, and it's really the gateway to the existing business district that's along Hamilton Avenue in College Hill. Formerly there was a Kroger building that was on the parcel on the left, and it closed in 2002. And there was a Schuler's Wigwam, a historic, very interesting restaurant with Frank Sinatra came and had cocktails there when he was in town, kind of a place that unfortunately closed in 2002. And these buildings were demolished in the late 2000s. Kroger was demolished a little bit before that. So these two corners have been inactive for 20 years, and it's been vacant grassy land for a decade. So the church worked with the city to acquire these properties and have been working with the city to redevelop them. One thing that we've talked about a little bit in these projects is just how long they take to really come to fruition. So there was a redevelopment attempt that was made in 2006 to 2008, but then the market crashed in that development scenario wasn't able to move forward. And then in 2015, there was an RFP issued and awarded to another development group, but ultimately that wasn't able to come to fruition either. And then in 2017, the city and SHRC issued an RFP and selected Penrose. So that's when we got involved, but this project has a long history, and it's really a tribute to SHRC and to the city to have that long-term vision and to stick to it to make sure something happened here. Next slide. So this is kind of a zoom in of the development. So Penrose is the developer for the two kind of L-shaped buildings that are mixed use on the two corners. On the far left, there is a single family housing development that is being done by our partner, DHAAS, a local company that's done a couple of these urban single family housing development scenarios. And the neighborhood was really excited about having both the for sale units on the left as well as the rental units and our mixed use buildings. The development includes 3 commercial bays spanning both corners. So A, B, and C, where the A, B, and C blue circles are they have approximately 10,000 square feet of commercial space to kind of start the gateway to the business district with some commercial uses. And then above are 171 housing units. So next slide. So because this project really came about through the city and SHRC working together, they helped set some goals and objectives for the project that we have designed around. We wanted to really create a sense of space and a start to the business district. Their North Bend Avenue and Hamilton are both highly trafficked streets, and so there's a desire to kind of calm the traffic down a little bit at that intersection to create a sense of space and create a more pedestrian-friendly environment. So our buildings are right up against the street with parking behind, which is consistent with form-based code. And the community also wanted to have a variety of housing types, so both the for sale home ownership piece, but also the rental piece. College Hills predominantly single family homes, and a lot of people want to stay in the neighborhood, but they don't have a place to downsize. So that was part of the objective here as well. Next slide. So some of our strategies include to make this a pedestrian-friendly place. We've got outdoor areas and dining areas as we work through our commercial tenants, how those outdoor spaces devoted to the commercial spaces will be programmed. But we've also got some balconies, and some of the residences are set back from the street. And we'll see a little bit rendering that shows that a little bit more in the following slides to kind of create a sense of neighborhood. And then you can see here, this is if anyone participating has ever gone to the College Hill Coffee Shop. If you walk out the front door of that establishment, this is what you'd see, our 2 buildings on the 2 corners. And the building on the right, you can see up on the 4th floor, we've got a roof terrace deck, which we're excited to have as an amenity for the project. Next slide. This gives you a sense of what we call door yards. And this is a new part of the form-based code, is to create some setback if it's residential on the 1st floor, but also to create a sense of, instead of just a monolithic building, to create the sense that there are different buildings. So you'll see we kind of zigzag the exterior a little bit, and we change some of the materials so that as you're walking down the street, you have almost the feel of you're walking through some brownstones instead of a large monolithic building. Next slide. So this is another view of that rooftop terrace, and then you can see the residential wings. They both kind of decrease the scale as you go down North Bend Avenue to the right and up Hamilton Avenue to the left. Next slide. Just another view showing some of the door yards. Next. And this project is under construction. So if you go to this intersection now, you'll see our concrete podiums and some framing going on up above. And I just wanted to share this banner that that Chirk wanted us to put together because they were so excited to finally have something after 2 decades of vacancy happening on this site. And due to COVID, we couldn't have our big groundbreaking ceremony like we would normally like to have. So Chirk organized a parade through the neighborhood to welcome our earth moving equipment. So that was really fun. There's a video on Chirk's website. People came out in their yards and held signs that said finally, and they were really excited. So, and there's Mayor CRANLEY and the blue suit crew of folks that helped bring this to fruition. So, as I've mentioned several times, heavy support from the city, both financially and in other ways. So we're really excited that this is happening. It's a bit smaller in scale than Aaron and Pete's projects, but again, very much desired by the community and really does change this intersection and hopefully really adds a lot to the business district for College Hill.
Well, great. Thank you, Amber. I'm going to stop share and rearrange my screen so that I can see what's in the chat room and see if we have any questions. It looks like our first question has to do with community involvement. So why don't we start with you, Amber? Biggest concern or biggest request from the community?
What we heard most often from the community was, please make this happen. Like, are you for real? Is this going to happen? Because it's been vacant and there had been several attempts. So a lot of what the community wanted to hear was commitment to the project and to making something happen and to being a neighbor. The College Hill Business District and as a tight-knit community, they've done some great things to support their local businesses. They've had like a fundraising campaign and helped pay the rent for some of the businesses on the main street so they don't have to close. So they really wanted a partner that would be present and committed for the long term. And they really wanted to have a lot of what we heard from the neighborhood was we really want a place for people who are elderly and want to stay in the neighborhood for them to downsize and stay close by. So those are some of the main things that we heard and are responding to here.
Wonderful. Aaron, do you want to talk about concerns and requests from the community stakeholders?
Yeah, sure, John. I would say it really kind of focused on 2 areas. One was the ongoing community engagement, and I think the recognition within Clifton Heights that wanting to be an active stakeholder and be part of our transformational and transparent development process. So to that end of hosting the charrette, having an online portal to continue to get input from the community, and I think more importantly, attending the monthly community council meetings really makes sure that their voice is heard, that the interests of the community are top of mind and what we're doing as we move forward into the execution stage. So it wasn't just the engagement at the local level in planning and through the entitlements, but even as we move forward through construction and execution. Secondly, and this is an issue that I think every urban neighborhood, and especially those that have a large institution like the University of Cincinnati, sometimes struggle with is parking. And I think that we heard loud and clear as a major concern within Clifton Heights. We knew that the development of the district at Clifton Heights, it was an active hospital, had a fair amount of visitors and 700,000 square feet. So, had a fair amount of traffic at one point. We knew that the district at Clifton Heights and what we were developing wasn't necessarily going to increase or dominate that parking challenge any more than it's going to solve any of those parking challenges. But we did realize the opportunity to influence at the community level and create a global parking strategy that kind of looked holistically across the entire community. How could we better manage the parking? How could we balance the parking with multimodal access? So make sure that what we're creating here is as much about vehicular access as it is pedestrian access and bike access, public transit access. So really kind of balancing that from a transportation perspective, but then also from a parking strategy. So we did help fund a community-wide parking strategy that developed a toolbox that city council and staff and leaders at the city level can then work closely with the community council to implement and help address a lot of the community concerns over parking.
Peter, same question. Biggest concerns, biggest requests.
So I really like what Amber and Aaron shared. I mean, there was a lot of similarities between these types of projects. I would say specifically to the Digital Futures Complex, the neighborhood, the community, the city, all these stakeholders understood that change was coming, and they were supportive of change, but they wanted to also make sure that with that change, that it wasn't going to leave the neighborhood behind. And so sometimes that manifested itself in the parking discussion, because we had the same parking conversations, and what they didn't want to see, what they did want. It was, it was both design related, but also, how it would be used related. But they also, there was other concerns, just how do you drive more neighborhood engagement with a product that doesn't exist here today, and that will be a completely different use than what was there previously. And so sometimes that, and the community benefits agreement tried to address some of this in terms of providing opportunity for that engagement, both in terms of the design and the pre-construction activities, but also during construction. We have goals around engaging folks from the neighborhood, and look to target certain zip codes for active workforce within those neighborhoods. But also from a post-construction standpoint, we had a lot of discussions around the ongoing interaction with the neighborhood. So the tech shop it was born from that, which I know I shared it before, but that's something I think is an incredible tool that will pay dividends down the road. But our hotel developer and operator, has commitments to hiring and employing lots of local residents. But it wasn't just about those kind of jobs. It's how do you start to draw connections with these companies that would locate there and build lines of communication, so that if residents did want to get a job, there was at least a dialogue to say, well, you need these skill sets, or you need this education, or you need this. And so it was, how do you make it real? And then finally, I would just say they didn't want the development to physically turn its back on the neighborhood. They wanted it always to be, public space was talked about a lot. And so having that accessible by everyone, even though it's a private development, making it more like a public space was a really important component.
Thank you. So I've been in the conference since Mayor CRANLEY's remarks and through multifamily and through the second panel. Mayor CRANLEY emphasized the vibrancy of downtown. He also gave us a message of hope for a post-COVID world and what it would look like to dine and work and return to our office environments and so forth. And then the second panel sort of went into the importance of place and activating regions. And you all have talked about that. I want to return. Oh, and then the other comment that was made was and I think it was Todd Pease was talking about Tri-County Mall and some of these regional malls that we're going to have to come to grips with. The three of you are looking at existing areas. You're redefining what those areas are like. There's a certain amount of demolition, there's reimagining, there's restructuring, there's public infrastructure, roadways, all of this coming together. And we're in an economic environment where maybe our biggest advantage is low interest rates, but we certainly don't have upward pressure on office rental rates or retail rental rates or so forth. So Peter, Aaron, Amber, in opposite order, can you talk about your capital stack and maybe the public involvement in your capital stack?
Well, I think out of the gate, I will tell you that, hospitality specifically is something that is taking it on the chin, obviously, in this pandemic. And that is a situation that we anticipate will come back. It's going to be slow. And I think, but everyone we've talked to are pretty cognitive of that. I mean, everyone seems to be pretty understanding that there's a weird dynamic that happens in the uptown area, which is also has a lot of hospitals and a lot of medical. And so there's different demand drivers, and you've got the university, and so you've got different things in play in the uptown neighborhood. Now, big picture, I think COVID does, this pandemic has done a couple of things for us. It has further emphasized the need to placemaking and really kind of creating a development that in the end of the day will be a strategic decision. So it goes beyond just making a real estate decision. And, clearly there are areas of town that, certain businesses there's all kinds of things that affect where people want to locate and where businesses want to locate. But if you think about it, part of the transition that we're seeing in the idea of real estate and leasing activity, it doesn't just become a numbers game based on the best deal you can get on real estate. It starts to become more of a business decision around, aligning not just your real estate goals, but aligning your business goals. And quite frankly, that's the way developers think about things anyway. And so why there is a real estate transaction as part of it. What we're selling is more than just the real estate transaction. We're selling the business transaction. And for us, we're pretty excited about our anchor tenant in University of Cincinnati and their Next Lives Here campaign. And just they've taken all their chips and they're all in on developing this innovation district. And so at the end of the day, that circles back and actually, from a responsibility, we've got to even put more emphasis on creating great places and the kind of spaces that are going to support that system. And I know I didn't answer all your questions, but I don't want to take all your time either. And I'll pass it to Aaron to see if he thinks differently.
Yeah, I would echo a lot of what Peter is saying there, John. And I think for us, when we look at the hotel component, the senior housing component, I think in the COVID era, I think, we got the similar reactions. And listen, like we went to market and had a great engagement with Cushman & Wakefield in identifying those development partners, but went to market at the end of March. Just as everything was turning south, we were out actively trying to find development partners. Ultimately, we're introduced to Crawford Hoying. And I think collectively we agree, and other partners agree, that this is not a long-term issue, that this is, when these developments open and when the hotel comes online in 2023 or senior housing online, we're back to pre-COVID performance. And so we know that, and already on hospitality, they're forecasting that, we're back to 2019 levels before 2023. And so we know that there's a future opportunity. We know now is the time to plan and take advantage of those down markets to plan for the future. And our partners share in that. I'll echo what Peter's saying too, that on the placemaking side, that is a critical component. And that is what really is appealing to identifying these other uses, bringing in these third-party development partners. In our individual buildings, when we develop student housing, we bring in building amenities that get the students out of their bedrooms and have that opportunity to collide and interact in our wonderful amenity space within the building. What we're providing here at a master development level is the space to interact between the buildings. And so we know that the value and investment returns in real estate is quite often made at that street level experience. And to the extent that we create and curate that space between the buildings and we have that placemaking destination, that just brings further value and a premium to the overall context that we're building. And so I can't emphasize more of what Peter has already said about placemaking. And, you know, the landscape, the hardscape, the signage, the wayfinding, everything that we're bringing into Straight Street will help to contribute to that active energy and bring all these uses together.
Amber, do you want to take us home for the next 2 minutes?
Sure. In our College Hill Station development, we spent a lot of time thinking about our outdoor amenities and the importance now of COVID of having not just a fitness room and the typical things that are inside a building, but having a variety of spaces where you can safely interact with people. So we've got a dog park on the site. I mentioned the rooftop terrace in one building. We've got like an outdoor patio with grill area set up by another part of the building. Behind one of the buildings, we have like a great lawn designed with some posts for hammocks and other things. So, and then we have a park area that's in between the single family and the multifamily building. That we've designed a lot of hardscape in so that we can do things like a food truck roundup and have other kinds of like safe outdoor events. And, you know, luckily we had the space to do those things before COVID. But we're seeing like now when people are interested, it's really what are those outdoor spaces that I can be in just to get out of the house. And as well, we've tried to maximize the number of balconies and other kind of private outdoor areas that we have. And, you know, on the city participation front, I just wanted to say we have the city has supported the project several ways, some streetscaping money to expand the feel of being in the business district. They've also provided a contribution towards the development on the private side, and they've also provided us with essentially a payment in lieu of taxes arrangement. So that has also contributed to the financial stability of the project. So the city's really used a lot of their financial tools to make a project like this happen that isn't using tax credits and other kinds of resources that some of these community initiated projects need to utilize to be financially viable. So the city has really played and public resources have played a role in this project that will really enhance the way that it integrates with the existing district and then the existing neighborhood.
Thank you so much. Todd, before I turn it back over to you, I just want to say what a pleasure it was to get to work with you on this panel and the development and the conversations leading up to it. All morning this morning, we've seen the best, in my opinion, of what we as real estate practitioners can bring to our community. And all of the panelists, including this panel, I just take my hats off. It's humbling to be associated with so many really good professionals. Todd, I think we're ready to close.
Couldn't agree more, John. I get to associate my face with all of your intelligence and market insights. So I take advantage of that every week. It's fantastic. People think I know what I'm talking about, and I just show up and, you know, screen share. Anyway, that was great though. Thank you for those talking about those developments and all the changes and all that stuff coming. This will be on YouTube. We are actually merging from YouTube. I shouldn't say merging, moving from YouTube to Vimeo. So I'm going to be able to put this video back into the lobby where you clicked to watch this event. So give me 24 hours and you'll be able to go back to that lobby and then see the replay and send it to all your friends. And you can tell your kids you're a YouTuber now. So, and you'll be famous. Thank you, everybody. Wonderful weekend. Email me with questions. Thanks for your time. Have a wonderful day.